Yeah, friends. Good morning, friends. I hope my voice is audible and the screen is visible to all of you.
Yes, sir, it is visible.
Okay, fine. So, in the last class, yesterday we have discussed about. So, before that, I have to just inform that instead of strategic management, I'll be taking financial management today because yesterday one of the financial management hour was taken by the strategic management faculty. So, first hour will be financial management, and the third hour and the fourth hour also will be having financial management only. So yesterday we have discussed about some basics of financial management. Right? We have discussed about the basics, and then yes, my voice is low. Is any Kumar Guru any doubts? Is it clear now?
Yes, sir, your voice is very clear.
Okay, fine. Yes, we have discussed some basics about financial management, right? We have discussed about the syllabus and then meaning, significance. We have discussed about the evolution of financial management. Then we have discussed about the scope. We have discussed about the importance. Then we have discussed about the objectives of financial management, right? We have two objectives. First one is profit maximization, then wealth maximization. So we have discussed about both objectives, and then we have discussed about the uh, arguments in favor and against both profit maximization and wealth maximization, right? Then we have discussed about key areas, financial decision. We have discussed about there are mainly three financial decisions or financial management decisions, we can say. So it includes financing decision, investment decision, and dividend decision. Financing decision is about how funds can be raised, and investment decision is about where to invest, and dividend decision is about whether we have to pay out the profit or retain. Right? These are the things we have discussed in the last class, and then we have discussed about we have discussed about the liquidity decision that when they are taking the financial decision or financial management decision, they have to take into consideration two aspects. First one is liquidity and profitability, then risk and return. Right? Then we have discussed about the factors influencing financial decisions. Then we started the cost of capital. Right? What is cost of capital? Can anyone answer? What do you mean by cost of capital? Cost of capital can be defined as the minimum rate of return expected by the investors, right? When the fund providers, the investors, what is the minimum rate of return expected by the investors, right? The investors include the equity shareholders, uh, then if someone is asking what subject, it is financial management. So as per the syllabus, as per the timetable, it will be strategic management. Since one faculty has taken this one of my hour yesterday, so I'll be taking Algarajas as hour today. So it is financial management. Yeah. Right. Yeah. So what is cost of capital? It is the minimum rate of return expected by the investors. So the investors include the equity shareholders, preference shareholders, and the debtors, right? Debtors in the sense the fund providers, creditors we can say. So those who are giving credit to the company, suppose the banks or debenture holders, right? Not debtors, debenture holders and banks and all. They are providing fund to the company. When they are giving fund to the company, what is the minimum rate of return expected by them, right? In case of debt, it is in case of debt, it is Kumara Guru signed out. It's a problem paper. Hello, sir. Subject some paper. No. So it is some paper, but we have 40% sum and 60% theory. So we should know some theory also, right? Without knowing the basics, how can do the sums, right? So yes, so this is the minimum rate of return expected by the investors, right? That is cost of capital. Then we have discussed about the significance of cost of capital, right? Then classification of cost, historical cost and future cost we have discussed. Explicit cost and implicit cost we discussed. Then specific cost and composite cost, average cost and marginal cost. All those things we have discussed in the last class, right? Then we have discussed about the determination of cost of capital, the problems in determination of cost of capital, right? Then we have discussed about the computation of cost of capital. Computation of cost of capital have two stages. First, you have to compute the cost of specific source of finance, right? First, you have to compute the cost of specific source of finance. Specific source of finance means the cost of debt, cost of preference capital, cost of equity capital, and cost of retained earnings, right? So, cost of debt. What is cost of debt? So normally it is interest, right? For the debt, company has to pay interest. That is cost of debt. And then cost of preference capital. What will be the cost of preference capital? It will be the dividend, preference dividend paying the company to the preference shareholders, right? This preference dividend. Then cost of equity capital. What will be the cost of equity capital? So how much return the equity shareholders are expecting from the company. So it includes dividend. Sometimes the investors expect growth in dividend, right? They won't expect the stable dividend every year. So they may expect growth in dividend, and some investors, some equity shareholders expect increased price, right? That increased market price of equity shares. So we have to calculate the cost of equity shares in different manner. So cost of debt and cost of preferred capital is almost similar, so we can calculate easily. But cost of equity share capital is having different concepts, right, or different dimensions. So that we will discuss. And then cost of retained earnings. Retained earnings means what the company is having, right, or past year's profit if they'll be having a reserve. So they retain that amount again in the business. That is retained earnings. So cost of retained earnings will be is like opportunity cost, right? It is not an actual cost; it's an implicit cost. We are not paying anything for the retained earnings, but still we have to calculate what is the cost of retained earnings.
Sir,
For that,
cost of retained earnings includes the assets of an organization.
assets of
An organization. I mean,
not as
earnings. I mean, the profits.
no cost of retained earnings is actually the retained earnings means the reserve that kept by the company, right? Or the
Okay.
profit of past years they are retained in the business. So when they hold it in the business instead of paying it as a dividend, right?
Yes.
So when they are paying it as a dividend, then it will go to the equity shareholders, the retained earnings, right? So then the equity shareholders may invest somewhere else, so they'll get a return,
Okay.
right? So
Okay.
that much return they will expect from the retained earnings, right? The business. That
Okay.
is the concept of cost of retained earnings. So if actually the retained earnings is with the company only, they are not paying any cost for that. But still, we have to calculate the opportunity cost. Opportunity cost means instead of keeping the money with the business, if you have given to the shareholders, shareholders might have invested somewhere else, so they'll get a return. So that return we have to expect from the retained earnings also, right? It is
Got it.
similar
Got
to
it.
cost of equity, but the only difference is cost of equity is the return expected by the equity shareholders, but retained earnings we are calculating the opportunity cost. If you distribute the shareholders when they invest, how much they'll get. So there are two elements. If you distribute it as profit, it as dividend, then there will be some tax element. So that you have to consider. Right, that we have to deduct from the cost of equity. And then we have to deduct the brokerage when they invest somewhere else, when they purchase some other shares. In that case, they have to pay some brokerage for that, purchasing that share also. So these two costs we have to consider, we have to deduct from the equity or cost of equity, then you can calculate the cost of retained earnings. So we have to do two adjustments, one for the tax, one for the brokerage on the cost of equity. Then you can calculate the cost of retained earnings. We'll do
Got
it in the problems. We'll be discussing in detail.
Got it, sir. Thank you.
Okay. So here we have, yes. First we'll discuss about cost of debt. Then we will move to cost of reference capital, then cost of equity. Then we'll discuss about cost of retained earnings. Then we'll calculate weighted average cost of capital. So here you can see that the cost of debt, right? Cost of debt. Someone is asking in the group page number 106. So I'm not discussing with the material provided by the DD. So we will discuss the although your doubts in the last classes, last one or two classes, completely will discuss only about your doubt and the question papers and all. So that time you can clarify. Now it is just for a conceptual class. So overall class I will take all the topics and later we'll discuss about the doubts. Right? Yes. So cost of debt. So cost of debt, as I have explained, it is the minimum return expected by the creditors or banks or debenture holders and all, right? So it's actually interest payable on debt. So if there are two concepts of cost of debt. First one is cost of redeemable debt and cost of redeemable debt. Cost of redeemable debt means if the debentures nowadays there is no redeemable debt. Still, we have to study the concept. So cost of redeemable debt means the debt will be there for long period. We cannot say it's for 10 years or 15 years. It's a long period. We cannot calculate the number of years. So that's why it is called cost of redeemable debt. So the cost of debt we can calculate before tax and after tax, because interest is a tax deductible item, no? So after paying interest only, we deduct tax. So it's a tax deductible item. It's an expense. So how to calculate the cost of debt before tax? This KDB. DB means debt before tax. So cost of debt before tax. KDB. Right? So it is I divided by P. I means interest amount is not rate, interest amount divided by principal amount. Or another way, we can say that it is interest amount divided by net proceeds. Interest amount divided by net proceeds. Interest amount means what is the interest that you're paying on the debt. Suppose 10% debenture of 1 lakh. So 1 lakh rupees is the value of debenture. Face value of debenture is 1 lakh and 10% is the coupon rate. In that case, 10,000 will be the interest amount, right? And net proceeds. The difference between principal amount and net proceed is that principal amount is the actual amount. So if you are issuing debenture at par, in that case, we can take principal amount as net proceeds. But in case of net proceeds, suppose you are issuing debenture at a premium. Suppose 1 lakh rupees debenture you are issuing for 1 lakh 10,000. In that case, net proceeds is 1 lakh 10,000. But the coupon rate will be same, 10%. Coupon will be calculated on the face value. So it will be 10,000 only. So it will be 10,000 divided by 1 lakh 10,000. So it will change. So net proceeds means by issuing the instrument, debt instrument, that is debenture, how much amount you will get. Or when you are taking loan, how much net amount that you will get? Right. Suppose you are taking loan, so they deduct some. The bank may deduct some amount, right? So you are taking 10,000 rupees loan. If the bank is deducting 500 for the account opening and hold, in that case, the net proceeds amount is only 9,500, even though you are taking a loan of 10,000, right? So that is called net proceeds. So in this way, you can calculate the cost of debt before tax. That is 1 divided by net proceeds. Then after tax, if you deduct the tax element from the cost of debt before tax, you can calculate the cost of debt after tax. You can see here, cost of debt after tax is equal to cost of debt before tax multiplied with 1 minus tax rate. 1 minus T means 1 minus tax rate. Another way you can include it in this question. Right, I divided by NP, interest amount divided by net proceeds multiplied with 1 minus tax rate. You can calculate directly. Directly you can calculate the cost of debt after tax. Or otherwise, you can calculate the cost of debt before tax first, right? Either in this way, then you can deduct the tax element so that you can get the cost of debt after tax. Hope it is clear. So we'll move to the question. We'll move to the question, right? Yes. So there are 4 questions. So in the first question, X Limited issues 50,000 rupees, 50,000, 8% debentures at par. The tax rate applicable to the company is 50%. Compute cost of debt capital. So how we can compute in this case? X Limited issues 50,000 rupees, 50,000, 8% debentures at par. The tax rate applicable to the company is 50%. Or can you calculate the cost of debt before tax and cost of debt after tax? For the first case, what is the equation? It is interest amount divided by net proceeds, right? Interest amount divided by net proceeds. What is the interest amount here?
4,000.
It is 50,000 into 8%. It is 4,000. What is the net proceeds? Since nothing is mentioned about, it's mentioned at par, right? Even just issued at par. So that means this is the face value, we issue at face value itself. So net proceeds is 50,000 itself, right? So cost of debt will be, cost of debt before tax will be 4,000 divided by 50,000, right? And what are the cost of debt after tax? This will be cost of debt before tax minus the tax element, right? That is
Tax
cost,
element, yes.
cost of debt before tax multiplied with 1 minus tax rate. You can see the answer here, right? 4,000 divided by 50,000 multiplied with 1 minus tax rate. Tax rate is 50%, so it is like 0.08 into 0.5. It is 4%.
Sir,
Right? Cost of
what do you mean by par?
par means whether the debenture is issued at par, premium, or discount. So when the security is issued, whether it is equity shares or preference shares or debentures, the company may issue at par or maybe at a discount or at a premium. Par means it's the same value as the face value. Suppose in this question, you can see 1 minute. This question is in this question you can see the value of the debenture is 50,000. Right, it's 50,000. It is
Yes.
face value. So the company has issued the debenture at par. At par means the same value, that is 50,000. That is why
Okay.
net proceeds become 50,000.
Okay, sir. Got it.
So that is at par, right? So we calculated for that. Then take the second case. All right, a while limited issues rupees 50,000, 8% debentures at a premium of 10%. The tax rate applicable to the company is 60%. Compute cost of debt capital. So now how will compute? You have to take the same equation. Interest amount divided by net proceeds. Can you just try, anyone? I hope someone have tried. So here the interest amount will be calculated, or the coupon amount or coupon rate will be calculated always on the face value. So interest amount will be calculated always on the face value. So here the interest amount is still 8%, 8% of the face value. Face value is 50,000. Face value means what is the value written on the document. Suppose the debenture is issued, the debenture certificate it might have written like 50%, 50,000. So that is face value. What is written on the document, whether it is share certificate or it is a debenture certificate, whatever it is. So what is the amount written on the certificate? That is the face value. That is the actual value of the security. So here it is 50,000, and the interest will be calculated only on the face value. So interest amount will be 4,000 itself, and issues 50,000 8% debentures at a premium of 10%. So the company has issued the debenture at a premium of 10%, right? So that means the net proceed will change. What will the net proceeds? It will be 50,000 plus the 10% of 50,000, right? So it is issued at 110%, 110%. So it will be 55,000. So net proceeds will become 55,000 and interest is still 4,000. So the cost of debt before tax will be 4,000 divided by 55,000. Right, 4,000 divided by 55,000. You can see the answer here. 4,000 divided by 55,000. It is 0.073. Right? Then what you have to do? You have to deduct the tax element. That is, multiply with 1 minus tax rate. Tax rate is 60% in this case. So 0.6. 60% means 0.6. So 1 minus 0.6. So balance is 0.4. Right? So 0.073 multiplied with 0.4 will get 0.0292, right? Or 2.92%. So in second case, cost of debt after tax is 2.92%. Right? You see the third question. So in this case, A limited issues, I think we can solve the problem, any one of you. So it is A limited issues 50,000. 8% debentures at a discount of 5%. The tax rate is 50%. Compute the cost of debt capital. Compute the cost of debt capital is given, and if the tax rate is given, you have to calculate it for after tax.
Okay. Then 5% discount in 50,000.
Yes.
4,000 by 5,
Yes.
95% of 50,000
Yes. Correct. Then into 1
into 1
minus tax,
minus. Yes.
0.5. So you'll get the answer. And just cross verify here. So cost of debt after tax is equal to 1 minus means interest amount divided by net proceeds. Interest amount is in this case 1 minute change. Yes, in this case it is 4,000 divided by 47,500. That is 95 percentage of 50,000 is 47,500 multiplied with 1 minus tax rate. 1 minus 0.5 is equal to, so 4,000 divided by 47,500 is 0.084 multiplied with 0.5 will get 0.042 or 4.2%. This is the cost of debt after tax. Then you can take the fourth case, right? B limited issues 1 lakh 9% debentures at a premium of, I mean, this question is not visible here. Premium of 10%, right? And the cost of flotation are 2%. So there is another element, cost of flotation. And the tax rate is applicable. Tax rate applicable is 60%. We have to compute the cost of debt capital. Right? So what is that cost of flotation? We have 1 lakh rupees is the face value of the debenture, 9% is the coupon rate. So the interest amount will be 9% of 1 lakh, that is 9,000. And the net proceeds will be 1 lakh into 110%, that is 11 lakhs. No, sorry, 1 lakh 10,000. And the cost of flotation is 2%. Cost of flotation means when the company is issuing debenture, so they have to pay some commission, they have to give some brokerage, all those things. So there will be some expenses when they are going for issue of debenture or any security.
The
So
cost
that
of
expense,
protection has to be deducted from this.
yes, that should have to be deducted from the
1
1
lakh
lakh
10,000.
10,000. So 2% of 1 lakh 10,000 has to be deducted from 1 lakh 10,000. This is the adjustment. You can see here the fourth case 9% of 1 lakh, that is 9,000 divided by, right, 1 lakh 10,000 is the net proceeds. From that you have to deduct 2% of 1 lakh 10,000, that is 2,200. So 1 lakh 10,000 minus 2,200 is 1 lakh 7,800. At 1 lakh 7,800 multiplied with 1 minus tax rate. Tax rate in this case is 60%. So 1 minus 0.6, it will be 0.0835 multiplied with 0.4, it will be equal to 0.0334 or 3.34%, right? You can say that 3.34%. So hope it is clear. So this is a calculation of cost of irredeemable debt or cost of long-term debt. If the number of year is not mentioned in the question, if the number of year is not mentioned, we have to use this method to calculate the cost of debt before tax and after tax. So next one is cost of redeemable debt. If the debt or debenture instrument, so debt here mainly we consider debenture as a debt. So we were really discussing all the terms based on the debenture. So we considering a debt as debenture, right? So cost of redeemable debt or redeemable debenture, you can see, right? So in that case, how we can calculate the cost or cost of debt? Redeemable means you can redeem it within 5 years or 10 years, right? So that means you have taken the loan, or suppose you have issued a debenture and raised the fund for 10 years. After 10 years, what you have to do? Up to 10 years, you have to give interest for every year, and at the end of 10th year, you have to give the maturity value and redeem the debenture. You will close the account, right? That is what redeemable debt means, right? So there will be a time period. It will be mentioned in the question. The time period will be mentioned in the question, right? So cost of redeemable debt capital may be calculated using the yield to maturity method. What is yield to maturity? Yield to maturity is here, right? So it's a method to calculate the interest rate. Or suppose if you are, you will be, you might have studied about IRR, internal rate of return, calculation of internal rate of return. The same method we have to use here. Or we can say that it's a trial and error method. Right? So here, cost of redeemable debt is equal to V0. V0 means present value of bond. That is net proceeds of bond, we can say. Net proceeds of bond or a debenture is equal to the present value of all the interests and the maturity value that you have paid. Right? This is the interest amount. Right? You can see here. This is the interest part. Sum total of all the interest that the company has paid and the present value of that. Right? That is the amount divided by 1 plus interest rate multiplied with number of year, right? So if t will change, t is equal to 1 here, so t will change to 1 year, 2 year, 3 year, like that. Suppose the bond is issued for 5 years, so all the 5 years you have to calculate the interest amount, present value of interest. Then at the end of 50th year you have to pay the maturity value, right? Maturity value means at what price you are redeeming the bond. So maturity value you have to pay. That present value of that also. If you add a present value of all the interest that you have paid plus the maturity value, it should be equal to the present value or net proceeds of the bond. Right? That interest rate is known as cost of redeemable debt. So we have to calculate this cost of debt here. So this is the cost of debt, but this you have to calculate by trial and error method. Right? We have no idea what is the cost of debt is. In last case, we know the interest rate. It's clearly given, but here is not mentioned at what price or at what discount rate you have to discount it. You have to use a trial and error method, and you have to see at what interest rate the present value of all the cash inflows, all the cash payments, that is interest and the maturity value, is equal to the present value of the bond, right? That is cost of redeemable debt. And you can calculate the after-tax cost of redeemable debt by deducting the tax element, right? The same way you can calculate the cost of debt here, and from the cost of debt you can deduct the tax element. That is cost of debt multiplied with 1 minus tax rate. You can calculate the cost of debt after tax. Hope it is clear. We'll go to the problem, then I think it'll be more clear. See the question here. So before discussing about this question, you should know two concepts, that is present value factor and present value annuity factor. Hope it will be knowing that present value factor. Present value factor or discount factor is the rate of discount or rate of interest at which you have to discount, right? So how to calculate the present value factor? Suppose the rate of interest is 10%, right? And number of years 3%, 3 years. Then how to calculate the present value factor? It is equal to 1 divided by 1 plus I raised to n. So 1 divided by 1 plus I is 10%. 1 plus 0.10 multiplied with, I'll show here, 1 divided by 1 plus interest rate I raised to n. So I will be 10% as I have told, and number of will be 3%, 3 years, right? In that way, you have to calculate the present value. I think all of you will know, so because all are MBA students, so I hope you'll be knowing the calculation of present value factor. And the present value factors for the number of years total is known as present value annuity factor. Suppose you want to calculate the present value of annuity factor for 5 years at 10%. In that case, the present value factors for 1 to 5 years will be totally known as present value annuity factor. Right? Okay, now we'll go to the question. So a 5-year rupees 100 debenture of a firm can be sold for a net price of 95.90. So net proceeds is 95.90. The coupon rate of interest is 4% per annum, 14% per annum, right? So 14 percentage of what? 14 percentage of 95.90 or 100 rupees? Which one? 40 percentage of? So then you have to calculate the 14% of 100 or 14% of 95.90. Coupon rate you have to calculate always on the face value. Face value is 100. 100. So rupees 100 debenture. That means 40 percentage of 100. So 14 rupees will be the interest amount, right? And the debenture will be redeemed at 5% premium on maturity. So it is redeemed at 5% premium on maturity. Right? That means the redeemable value will be 100 plus 500, 5, right? And the maturity, the firm's tax rate is 35%. So tax rate is also given 35%. So in this question, the present value factors at 15% and 17% is given. Sometimes it won't be there in the question. In that case, you have to calculate the present value factors. Yes, Kumaraguru, any doubts?
No, sir. No, sir.
Okay, you raised your hand again. I think it's by mistake. Okay, so here it is given 15% and 17%. So we can rightly take 15% first and 17%, or you can take 70% first and 15%. Two rates you can take. Sometimes if this part is not given, right? Sometimes question this part will not be given. So in that case, you have to take one rate and hypothetical rate you have to take, and then you have to see whether the value is above or below the present value. Then you have to check another interest rate, right? Suppose you have to take 10%, then you have to calculate the present value factors for 5 years. Then if it is based on that answer, again you have to take another rate of interest. So at least you have to take two rate of interest for the calculation, right? One should be, if you discount or if you find the present value, so one present value should be less than this 95.90 and one should be more than 95.90. Then only you can apply the equation and find the cost of debt in this case, right? Suppose here it is given 15% and 17%, right? And the present value factors for 15% is 0.870 for first year, 0.756 for second year, 0.658 for third year, 0.572 for fourth year, and 0.97 for fifth year. How to calculate this? Actually, this is 1 divided by 1 plus 0.15 raised to 1. This is 1 divided by 1 plus 0.15 raised to 2. This is 1 divided by 1 plus 0.15 raised to 3. This is 1 divided by 1 plus 0.15 into 0.15 raised to 4. So that's how we calculated present value factors, right? Sum total of this will be present value of annuity. Present value of annuity factor at 15% for 5 years, right? That is what present value factor and present value annuity factor. So now we'll move to the solution or how to solve this case, right?
Sir, I got a small doubt.
Yes.
How was this percentage, that is 15 and 17 arrived at?
That's what I told. Here in this question itself is given 15 and 17%. But sometimes if it's not given, you have to take one interest rate. At least normally we'll take 10%. You start with 10%. Then you see whether the present value is more than 95.90 or less than 95.90. If it is less than 95.90, you have to increase the present value. To increase present value, you have to take a reduced interest rate. So next you can try with 8% or 5%. Right? Suppose at 10%, if the present value is more than 95.9, in that case, you have to reduce the present value. For reduce the present value, you have to increase the interest rate. So next you can take 12% or 15% like that. So You start with 10% if the rate is not given.
Okay, that is basically hit and trial method.
Yes.
Okay, sir. Okay, understood.
Okay. Yeah. So now to go to the solution. Yeah. So can you see the answer here? Right? So this is a V0. V0 is the present value. Present value actually is net proceeds. That is 95.90 in this case. Is equal to, is n is number of years, right? So 5 years, t and is sum of for 5 years and t is equal to 1. This is the interest amount. That is 14% of 100. Right? This is maturity value, final amount. It is redeemable at 5% premium. No, that's why it is 105. 100 rupees is the face value and it is redeemable at 5% premium. So 105 is the maturity value. This is interest rate. This 14 rupees you will get for 5 years, right? But only one time. You will get for 5 years. First year, second year, third year, fourth year, fifth year. So you have to calculate it for 5 years. That's why this sigma, sum total of the interest amount, right? And this 105 will receive only at the end. So you have to calculate the present value of 105 after 5 years, right? So we are receiving 105 after 5 years. So what is the present value? That you have to calculate, right? So here you have to take present value of annuity, right? Here you have to take present value factor because it is sum total of 5 years. So 14 into present value of annuity factor. So 15% at 5 years. What is present value of annuity factor? Actually, it is the present value factors, total of present value factors for 5 years, right? So it is 0.4972. 0.4972 is the present value factor. Present value annuity factor, right? At 15% for 5 years. Not this, sorry. This is the value. Present value annuity factor at 15% for 5 years. 3.353, right? And 14 rupees is the interest amount. So 14 into 3.353, you will get the present value of total interest plus this is the maturity value. 105 into present value factor at 15% in the year 5. This is only one time. So this 115 you will be giving only in the end. So only one time you are paying. So you have to calculate 0.4972. So 105 into 0.4972. You will get 52.185. And the present value of total interest is 46.94. So total amount will be 99.125. So the present value of total interest and the maturity value at 15% interest rate is 99.125. It is actually more than the present value, right? Present value is 95.90 only. And the present value at 15% it is 99.125. So what you have to do, when the present value that you calculated is more than the actual present value, what you have to do is reduce the present value. To reduce the present value, what you have to do? You have to increase the discount rate or you have to increase the interest rate. So from 50%, 15% will increase to 17%. Now you try with 17%, right? The same interest rate, interest amount 14, and present value of annuity factor at 17% for 5 years. You have to take that is 3.2. Is 3.2 plus 105. 105 is the maturity value multiplied with present value factor in the fifth year, right? At 17%, that is 0.456. So 14 into 3.2 is 44.8. 105 into 0.456 is 47.88. So total amount is 92.68. So the present value of all the cash outflow, that is interest and maturity value, at 17% discount rate is 92.68, which is less than 95.90. So we got a interest, we got a present value which is less than 95.90 and one is more than 95.90. So now we can apply it in the equation, right? This is the cost of debt equation. Actually, the cost of debt equation is this is 15. 15 is actually lowest rate. Lowest rate. Sorry. The lowest rate plus the present value at lowest rate minus the actual present value divided by present value at lowest rate minus present value at the highest interest rate, right? You just note it if you want. Cost of debt or yield to maturity will be equal to lowest rate. Lowest rate is 15%. No, so actually it is 15%. 15. Yes. Is there any doubt? Is there any doubt?
No, sir. You can go ahead.
Okay, fine. So it's the lowest rate plus 3.225. 3.225, how do we go to 3.225? It's 99.125 minus 95.90 divided by 6.445. 6.445 means 99.125 minus 92.68. Multiplied with highest rate minus lowest rate. Highest rate we have taken is 17% minus lowest rate is 15%. So it is 2. Right? So you get 15 plus 1. Approximately 1 you will get. And it is 16%. So 16% is the discount rate. At 16%, if you apply here in the equation, you will get 95.90. That is the cost of debt. Cost of debt of redeemable debt, right? Cost of debt of redeemable debt. So this is before tax cost of debt. If you want to calculate after tax cost of debt, what you have to do? You have to deduct the tax element, right? What's the tax rate here? It is 35%. So 16% the cost of debt before tax minus the tax element. So 16% into 1 minus 0.35. You will get 10.4%. That is 16 multiplied with 0.65. You will get 10.4%. Hope it is clear. So there's another question. There you have to consider the cost of flotation also, right? Due to the limitation of time, we are moving forward to the, yes, here is a question. We'll take this question here, right? So in this case, there are two questions. So assuming that a firm pays a tax at 50% rate, compute the after-tax cost of debt capital in the following cases. There are two cases, right? One is perpetual bond at par, coupon rate of interest being 7%. That is one bond or one debt. Another one is a 10-year 8%, 1,000 per bond sold at 950 less 4% underwriting commission. Underwriting commission is similar to flotation cost, right? This is underwriting commission. So yes, so in the first case, actually it is whether it is redeemable bond or irredeemable bond. The first case, that is perpetual bond. Perpetual bond means it is irredeemable, right? Number of years also not mentioned. So it's a perpetual, it is irredeemable, right? So in case of irredeemable bond, how to calculate the cost of debt? It is interest amount divided by net proceeds. What is the interest amount here? 7%. So amount is also not given, but still you can calculate because it is given that 7%. So, and it is issued at par also, right? Issued at par and rate of interest is 7%. So whatever the value of bond you take, you will get only 7% as the cost of debt. But you have to calculate after tax. because tax rate is 50% now. So after tax cost of debt will be 7% multiplied with 1 minus 0.5. It will be 3.5%. Right? A perpetual bond sold at par. So it is issued at par. Suppose you take the value of bond as 1000 rupees. In that case, the interest amount will be 7% of 1000, right? 70 rupees. So 70 rupees divided by 1000. 7% only. Multiplied with 1 minus tax rate. 1 minus 0.5. So we'll get 3.5%. Second case is redeemable debt because it is mentioned that 10 year. So within 10 years to redeem. So 10 year, 8% rupees 1000 per bond sold at rupees 950 less 4% underwriting commission. So you have to deduct the underwriting commission also, 4% underwriting commission also from this 950, right? 950 is the selling price of the bond. From the 950, you have to deduct underwriting commission. Then you will get net proceeds, right? And the face value is 1000. And nothing is mentioned about the redemption, whether it is premium or par or discount, nothing is mentioned. So you can assume that it is issued at par only. And it is redeemed at par only, right? So if nothing is mentioned about the redemption, so it will be generally redeemed at par. So the maturity value will be 1000 only, right? So interest amount will be 8% of 1000. So interest amount will be 80 rupees. Maturity value will be 1000 rupees. Net proceeds will be 950 minus 4% of 950, right? What is 4% of 950? It is 38 rupees, right? So the present value of the bond or net proceeds of the bond will be 912. We have to calculate the rate of discount at which all the interest, that is 80 rupees you are paying for 10 years, present value of that 80 rupees you are paying for 10 years, plus the present value of the 1000 rupees that you are paying at the end, together is equal to 912 at what interest rate. So you have to calculate that interest rate. And in this case, nothing is mentioned, as I have told. No interest rate is given, whether it's 10%, 15%, nothing is given. So we have to take an interest rate, then we have to start. So we'll take an interest rate of 10% first, then we'll see whether the percentage value is higher or lower, then we will move to the other interest rate. Right? Can you just try without looking at the screen? So as we have discussed, in the first case you take cost of debt is I divided by NP. So you take 100 rupees or 1000 rupees, whatever it is, it will be same only, 7%. Multiplied with 1 minus 0.5, 0.035 or 3.5%, right? 3.5%. Then the second case, that is the case of redeemable bond or redeemable debt. So there was you take first equation, that is present value is equal to sum total of the present value of interest. This is what sum total of present value of interest element plus present value of the redeemable value or maturity value, right? So 912. What is 912? It is 950 minus 4%, right? 950 minus 4%. 4% of 950 is 38. So 950 minus 38 is 912, right? So 912 is equal to 80 rupees for 10 years, present value of 80 rupees for 10 years, and 1000 rupees at the end of 10th year, present value of 1000 rupees at the end of 10th year. So you have to take the present value annuity factor to calculate the present value of 80 rupees for 10 years, and you have to take present value factor to calculate the present value of 1000 rupees at the end of 10th year. So this is for 10 years, this is 10th year. That you have to understand. This is only at the time of 10th year. This is for 10 years. 10 times, right? Yes, we start with 10% first. So present value is equal to, that is present value is 950, 912, right? 912. How do you calculate? 80 rupees interest amount. 80 rupees multiplied with 6.1446. 6.1446 is the present value annuity factor at 10% interest for 10 years. That is 6.1446. So you will get the present value of total interest for 10 years. And this is 1000 rupees multiplied with 0.3855. 0.3855 is the present value factor, not present value of annuity factor. It's a present value factor in the 10th year, right? This is only one time. So in the 10th year, so 1000 into 0.3855. So you'll get 491.57 plus 385.5. Total amount is 877.07. So 877.07 is the present value of all the interest amounts and the final maturity value at 10% interest rate, right? Which is less than this actual present value, that is 912, right? Actual present value is 912, that is net proceeds. So what you have to do to increase the present value? What you have to do to reduce? You have to reduce the interest rate or discount rate, right? So we have to take a 10%. Now we have to take a discount rate which is less than 10%. You can take 8% or 7%, but it is better to go to 5%. So it easily calculate. Suppose if you take 8%, and if it is not 8%, again you have to take 7%. Like that, you have to calculate multiple times. Instead of that, if you take 5%, the answer won't be accurate, but you'll get the answer, right? It won't be that accurate, but you'll get the answer easily. So next you will take 5%, right? We have tried with 10%. Now we have trying with 5%. So 80 into 7.7217. 7.7217 is present value annuity factor at 5% for 10 years. Present value annuity factor at 5% for 10 years. Plus 1000 into 0.6139. 0.6139 is the present value factor at 10%, at 5% in the 10th year. 0.6139 is the present value factor at 5% interest rate in the 10th year, right? So you will get 617.74 plus 613.9, which is equal to 1231.64. So which is more than or greater than this 912. So we got a lower value than this 912 and a higher value than this 912. So now we can apply it in the yield to maturity equation or IRR equation, right? So this IRR equation, it is equal to lowest rate plus the present value at lowest rate minus the actual present value divided by present value at lowest rate minus present value at highest rate multiplied with highest value minus lowest highest interest rate minus lowest interest rate, right? So here lowest interest rate is 5%. So take 5 here, right? The present value at lowest interest rate is 1231.64. Can take that value minus the actual present value, that's 912, right? 912 divided by present value at lowest interest rate, that is same 1231.64 minus present value at highest interest rate, that is 877.07, right? Yes. Then multiplied with highest rate minus lowest rate, that 10 minus 5. So you can get 9.51%. This is before tax. So deduct tax. As a tax, it is 50%. So 9.51 multiplied with 1 minus tax rate, 1 minus 0.5. You will get 4.755. So we got the answer 4.755%. This is how we calculate cost of redeemable debt. So it's already 11 o'clock. So we'll discuss rest of the topics in the next hour. That is 12 to 1. So thank you. If you have any doubts, we can discuss it in the next hour, I think. 12 to 1.
Thank you, sir.
Okay.
Good morning, everyone. Hope
Good
I'm
morning,
audible.
sir.
Yeah. Good morning, ma'am. Okay. When yesterday we were having a discussion about the third unit, so we'll start from there. And somebody was maybe requesting yesterday for case study and all. So I thought we'll have one case study discussion of unit 1 and how we can go with the case study analysis we can discuss in this particular maybe session, plus we can cover the third unit. So this is what I planned, and we can have a discussion about the same. So yesterday we were discussing about the pricing. So hope the screen is visible to all of you, right? Yeah, fine. Fine. So these are the things we had a discussion yesterday. That is what is pricing decision, why it is important. So what is the maybe the explanation or keywords we can keep for the term called price? So it's an expression of value in the monetary terms. Okay, so the pricing is a kind of maybe a process where we have to consider multiple factors. Okay, this is not a simple decisions to take, and all the other elements of the maybe the marketing or maybe the entire organization will be depending on this particular decision, because pricing is having a lot of effect. It will affect the profit, it will affect the demand, it will affect the supply, it will affect the each and every decisions of the organization. In that way, pricing is very important. Okay, so this is what we had in yesterday's discussion. Okay, so there are internal as well as external factors we discuss for the pricing decision. So there are some internal factors that we need to consider, and there are some external factors that we need to look before we maybe fix the price. Okay, so these things we already covered yesterday. So customer value, product cost, all these things we had a discussion. Then pricing objectives and approaches. So there are some objectives you can find here. Okay, so before we fix the price, there are different intentions. Okay, so this intentions are having different outcomes. It is not only for profit, it's not only for maybe something else. So each and every pricing will be having different objective. Okay, so this is what we are going to discuss today, and maybe later, as I said, we can discuss about the case and maybe how to do the case. Okay, so the pricing objective you can find, profitability objectives is the first one. So suppose if you are going with a new product or existing product with a different pricing or maybe different quality things and all, so we may have an intention, that is making more profit. That is, you are not looking other factors majorly, you are looking about certain fixed maybe percentage of profit out of that particular pricing. Okay, so this particular objective you can keep as a profitability objectives. So here you may not be looking at the number of or quantity of outcomes, or what is the pricing of the competitors, or is there any competitors in the market, what is their price, how they are pricing, what are their factors. That is also not there. Then again, you are not looking about the consumers whom you are targeting, who is your targeted people, whether they will be able to afford. All these things are not a matter for you. Your mere objective of your pricing is profit. Okay, so you will be fixing a certain percentage of profit along with the cost. So in that way, you are fixing the price. This is happening in the profitability objectives part. Okay, so here other factors, as I mentioned, won't be the criteria. Okay, so they will be directly looking to that part. Second one is volume objective. So here the mere purpose of your pricing or objective of your pricing is economies of sale. That is larger quantity of sales only you are targeting. To achieve that, you may be having a price. That's it. That means you are fixing a price. It will ensure larger volume of sales. So you won't be going for maybe exhaustive pricing or high pricing or luxury kind of pricing, or you are not fixing the profit. What your target is having more sales. Okay, suppose if you are having more competitors in the market, majority of the competitors are having similar pricing. Okay, so what kind of pricing you have to adopt? It is maybe looking for the market share. Okay, so in order to ensure that, what you will do, you have to have a better pricing which is targeting more sales, that is capturing the demand from the competitors and all. Okay, so that is your objective. Here you are not fixing the percentage according to the required percentage of profit and all. Your intention is only have more sales. Okay, the volume of sales or the quantity of sales is the objective. To achieve that, you are having that particular objective while fixing the price. Then third one, meeting the competition objectives. That means in order to curtail the competition or extra competition, maybe threat in the market, you are having a pricing. This is to overcome. Okay, this is to overcome the particular uh, maybe competition in the market. So your pricing is to compete with the competitions or competitors pricing. Okay, so whatever the competitors price, you may have lesser price of that particular product which are selling by the competitors. So your intention is to defeat the competitors or overcome the demands which are captured by the competitors. So meeting the competition objective, meeting or getting an edge over the competitors, these are the intention, okay, behind the competition objectives. Okay, then the fourth one is prestige objectives. Okay, so here what is this prestige objectives? In order to have that luxury kind of expectations, suppose if you are having a targeted consumers who are into a particular category of people and all, you may not be able to have that maybe elements. So you have to have a strategy where you have to fix a price not based on the percentage of your profit intention, not based on the quantity of output that you want to sales, or not based on the competitors. It's all about the types of customers or consumers who are using it. Okay, so that is also matter. Okay, whenever Benz, Lamborghini, all this maybe international luxury brands, if they are going for a new product, they won't see about the cost part. They won't see about the competitors' price. They may consider, they won't see the number of quantity of output they want to sell and all. They will see what is the base price that already quoted in the market, because that is also matter that they can't sell something for maybe the cheaper part. Okay, so that is also there. Fine. So these are the objectives. There may be multiple objectives for the same pricing. There may be even single objective for the single pricing. Okay. So the pricing may be a combination of these objectives or single objectives. Okay. So that's what. Now we will go for the next maybe the pricing approaches and all. So this is also there in the syllabus. There are few questions which are based on this particular uh, approaches. Okay, so we have to have different approaches for pricing. The one is cost based, second buyer based, and third one is competition based approach. So this is whenever you are asked to write about the approaches, you have to focus on these three things. Whenever you are asked to talk about objectives, you have to talk about the previous one. Okay, so that is what you need to keep it in mind. So cost-based approach is the approach of pricing where you will be considering the cost of your materials and raw materials, or maybe other cost of productions. Okay, that is, it can be human or any other resources. So whatever cost you incurred, that will be the base for your maybe the pricing. Okay, so based on the cost plus profit, you are making the price, or you are fixing the price. This is what happening in the cost based approach. So in this approach there are a lot of advantage, there are a lot of disadvantages. Advantages in the sense, you will be having a fixed profit, and you will be ensuring the price is covering all the cost and all, and you will be having a fixed maybe a regular kind of inflow, because if you sell something we can ensure that it is covering the cost. Okay, then you will be having proper maybe segregation of total price into variable cost, fixed cost, then profit part, like that. So this is the advantage. And disadvantage side, if you are looking for cost based approach, you are not considering the buyer's perception, whether buyers will be able to afford it. All those things are completely avoided, because you are not looking about the buyer's affordability or targeted people's affordability and all. Okay, then again you are not looking to the competitors part. What is their price? How are they? What are the components of their price? Total price, how much, and out of that, how much price is there for maybe the how much is the maybe the profit they are keeping for the company and all that and all not there. Okay, so this is the major problem with the cost based approach. Again, competitors part you are not looking to or considering for your pricing. So this is the first maybe pricing approach. Second, buyer based approach. So here you are giving more importance for your consumers or your buyers. It can be customers or consumers, whoever it is. Okay. So you are looking to them, and according to their affordability, according to their preferences, according to their acceptance, you are fixing the price. Here the major issue with this, and you may not be looking much importance for the organizational interest, that is cost, how much you have to keep as a profit. All these things are not relevant here, because you are fixing the price based on the buyer's intention, buyer's maybe consideration. Okay, so this is the bias base. What is the uh, advantage that we already discussed? What are the problem with the bias based approach? The cost part, you are not having any consideration while fixing the price. Okay, and again competitors part, you are not looking. Again, you are giving more importance for the buyer. Then you can see the last maybe approach for pricing is competition based approach. As the name maybe gives the clues, right? So competition is the major basis for fixing the price. Okay, so you will be seeing the competitors, pricing strategy, price level, and again number of competitors, and all those things will be the matter there. Like that, you are fixing the price. Okay, so these are the three base approaches for maybe pricing for a product. Okay, so you can discuss about the advantage and disadvantages. You can compare each other. That is the best way. I hope all of you are clear about this discussion. Hope all of you are clear. Can you put some comments or confirm so that we can go ahead? Okay, fine. You see, there are people who are not from the commerce background and all. So please check the explanations which are there in the textbook later. Okay, these points, key points, may be sufficient for those who are able to write by themselves. But explanations, what I am doing here may not be sufficient. Okay, so you have to have that maybe points in your mind while preparing for the examination.
Sir, it would be helpful if you can give us some important topics also.
Yeah, see, whatever maybe topics I found very important, that only kept it in the PPT. Otherwise, no, that entire maybe the content that you are seeing in the PDF, there are too much explanation. That's what I found.
Yes,
So
sir.
whatever is important, only main heading with the minimum explanation I'm doing here. But better have a overall reading about the textbook, because we can't read entire points here. This 5 hours or 6 hours may not be sufficient, but the heading whatever I am discussing here is very relevant, because over the years this kind of topics only asking in the examination, but other topics also important. Okay, you will be getting some questions based on that also.
Okay, sir. Thank you.
Okay, Murali sir. Fine, so that's it regarding that, and now we'll continue with the discussion. Okay, one second, let me check with one more link. Give me 1 minute. Okay. Okay, fine. So these are three heading we covered. Now we can discuss about the pricing policies and constraints. Again, as somebody Murali sir requested or asked, we didn't maybe put everything, but whatever is important, we have kept those things. Okay, so this is what you can maybe keep it while preparing for the exam. So this is a procedure for pricing policy. Okay, so how and what are the steps we need to consider while fixing the price? Okay, so these steps you can maybe learn, because this can be even asked in the examination. There are few questions in the previous exams and all based on this maybe the pricing objectives as well as stages. Okay, so here you can find Selecting the pricing objectives is the first step. Okay, so previous sheet we had a discussion. What are the different pricing objectives? Okay, any of those objectives can be the first step for fixing the price. Then second one, demand determination. That is determination of the demand. How much is the total requirements in the market? Even though we are having a different objectives, demand we need to forecast first. Okay, so without demand forecasting, we won't be able to do that. That is what we need to look for the second place. Then estimation of cost, estimating the cost in the sense the total cost of the particular product should be estimated, including the variable cost, fixed cost of the particular product. Okay, so how much will be the cost per unit we need to check, because in order to fix the price of the particular unit, you need to check how much is the total cost of that particular unit. Then analyzing competitors cost, price and offers. So before we go for any pricing, it can be a goods, it can be a service, whatever it is, we need to check how much is the cost for the competitors. So the competitors cost in the sense the cost of their product prices, and maybe from there where they are mobilizing the materials, all those things have to be checked. Then what are the offers they are providing, because that offers also matter here. You need to check what kind of offers they are providing, and all accordingly you can have the decisions. Okay, so these are the things you need to find for the fourth maybe stage. Fifth one, selecting a pricing approach. Okay, what is the approach you have to follow to have the pricing? Okay, so we have discussed about the approach in the previous slide, that is objective ways, right? The different approaches we have discussed, three approaches. Any of those approach can be confirmed once you have all this analysis. Okay, then you can find high and low. Between that you can find different floors or different levels of pricing and all. In the uh, in the in the textbook you can find there are some pricing, okay, methods and all. Again, that also summarized here. Then once you have the pricing approach, you have to select the final price. Okay, so these are the stages you need to remember in order to fix the price. Okay, that is pricing policies and pricing stages or steps you need to follow like this. So these are the things. Okay, somebody's fine. Okay, so that's it regarding that. Then how the pricing is related to product life cycle, that you can find here. How a pricing of a product is related to the product life cycle. Okay, so how it is related, the pricing you can find here. Okay, so here you might be seeing the product development stage and all. Again, this is the line which is showing the sales part. Then profit also you can find here. Okay, profit is negative in the introduction stage, and from the growth stage it is coming here, and maturity stage it is declining, and sales in the last declining stage will be, it's almost touching the negative. Before it is going negative, they'll be leaving the market, like that it is given here. So you can find two lines here, one is sales, another one is profit. So pricing will be accordingly. Okay, so the each phase represents different opportunity and constraints of the price. So whenever you are having more chance for sales, that time you have to increase the price, and you have to have the maximum profit. So that means more sales, more profit. And according to the sales and maybe the product cycle stages, the price also can be adjusted. Okay, if you are putting a very high price in the beginning, sometime it may cause a lot of demand shortage, and again it will be creating a loss in the beginning. That is why you can find this profit line is below the zero. Okay, below the axis, so that it means it is creating a negative value. Okay, so these are the things you need to remember for the product life cycle stage with the profit or maybe the price. So this is also the new syllabus, and there are some different pricing method you can find here: skimming, penetration pricing, cost plus pricing. So what is skimming pricing? Suppose if you are looking for a new product, okay, sometime you may get a question in the examination by asking this. That is, suppose if you are going for a new product, okay, so you are going for a new product, and what is the pricing method you need to focus in this? Okay, so in order to have this pricing, there are different methods. Skimming price is talking about you will be having an highest maybe price in the beginning. Beginning you will be charging high, and subsequently you are reducing the price. Okay, suppose if you are implementing a new product, okay, that product will be having a high price in the beginning. Okay, then uh, they will be having lesser pricing in the coming maybe the time, that is in future they may reduce the price. So that is what this particular team is, maybe that particular pricing is talking about. Okay, so high price, then they are reducing. Its opposite is coming with the penetration pricing. That is, you will be having a lesser price in the beginning. That is, the price of the product or services will be very less in the beginning, and later it will be increasing. That is, it will be penetrating. Okay, so that is beginning it will be low, later it will be high. So that is subsequently they will be increasing the charges. So that is what the penetration pricing. Okay, skimming is top to bottom, that is high to low, and penetration is low to high. Okay, this is the difference. Then third way of maybe pricing is cost plus. That is, this is very common. That is, you will be charged very less. Okay, that is very low price, and later the uh, price will be calculated based on the cost plus certain percentage of profit. You will be calculating the cost first. Okay, then you will be fixing the maybe the profit along with that. Okay, this is cost plus pricing. So these are the three methods. So pricing in industrial, business to business market, and pricing on the internet, like that. Few topics are there. You can just go through it. These are like very common, but these three topics you can just remember what are the different pricing methods. Okay, skimming, penetration, and cost plus pricing. So again, you can find whatever we discuss here. New product pricing methods we already discussed: skimming pricing, penetration pricing, and product mix pricing strategies. Okay, that means you will be having multiple products. What is product mix and all we already discussed. Okay, product line pricing, optional product pricing, captive product pricing, and by product pricing, product bundle pricing. Then price adjustment strategies, discount and allowance pricing is also there. Then discriminatory pricing, psychological pricing, value pricing, promotional pricing, geographical pricing, international pricing. So there are so many maybe pricing methods you can find in the textbook, but few of the maybe types we are explaining here. So especially the new product pricing and all we can find here, when we can apply skimming price, when we can apply penetration pricing and all we can find here. Okay, fine. So we can go through it. Allows the manufacturer to quickly recover its research and development cost. That means you will be having a highest pricing in the beginning. Okay, so in that way you will be getting more money in the market, more profit in the market from the beginning itself. You are not waiting for long years to recover your cost and all. Uh, this is what market skimming pricing is for. Again, skimming strategy is useful tool for segmenting products overall market, and that is fine. It permits marketers to control the demand in the introductory stage of the product life cycle, and then adjust the productive capacity to match the demand. That is you are deciding the price in the market. If you are having high competition and all, you won't be able to go with skimming pricing. Okay, you can't go with the skimming pricing. You have to go for penetration, because you will not be able to enter the market with that price, exhaustive pricing. Okay, that highest pricing and all. Second is penetration pricing, where you will be having lesser price in the market, and later you will be increasing the change. Maybe the market is highly price sensitive, and low price stimulates market growth. Production and distribution costs fall with the accumulated production experience. A low price helps discourage actual and potential competition. So all these things are the, if you are really having all these environmental factors or all this situational support, you can go for the penetration pricing. So there you will be charging lesser price in the beginning and more in the future. Okay, so this is what for the market penetration. Then price adjustment, there are some price adjustment strategies you can find here, where we can have the changes in the price. Okay, discount and allowance pricing, reducing the price to reward customer response, so such as paying early, promoting the product and all. That is cash on delivery. Instead of cash on delivery, Amazon also you can find, if you're making the mobile app payment. Okay, that is Google Pay payment and all. There may be 10% or 10 rupees discount, some extra discounts they are giving if you are making the payment advance. So discounts and allowances are there. Then discriminatory pricing is the second one, adjusting the prices to allow for differences in customers, products, and locations. Same company, same product, but in different situations and locations, they are charging differently. This is what different discriminatory pricing. Psychological pricing, adjusting the prices for psychological effect. Okay, so you will be having different types of people, that is early adopters. Okay, laggards, all these things we had a discussion, who will be buying the product immediately. So if you are giving a particular offer for the people, the first 50 customers, the first 20 customers, a special pricing and all. So this is what psychological pricing. Okay, the people who are following them will be getting little high price like that. So this is what psychological pricing. Value pricing, adjust prices to offer that right combination of quality and services at a fair pricing. Okay, so you are giving extra value for the consumers with the combinations and all. Okay, so this is what value pricing. Promotional pricing, temporarily reducing the price to increase short-term sales. So you will be having promotions according to the, maybe the seasonal. Okay, some offers during the celebrations, or maybe the seasonals. Okay, some festivals and all. So geographical pricing, we already discussed different geographical location for the same product for the same companies. Again, different prices and all, in order to, maybe sometimes some geographical location, maybe rural, urban, all this. Accordingly, there may be some discounts and all, in order to capture the differences among the people who are in different geographical locations. Then international pricing, adjusting prices in international, maybe consumers and all. International pricing is also there. You will not be getting the same product in international market with the same price, because of the differences which are there in the different markets, national as well as international. So these are the price adjustment strategies you have to remember. Okay, so next, product mix pricing strategies. So ceiling price, customer assessment for unique product features. Okay, customers assessment of unique product features and all. So if you are having maybe different products. Okay, that is product mix we already discussed. In that, if you are looking for unique features and all, you will be having a different pricing. Then optional product pricing, pricing optional or accessory products sold with the main product. Okay, so you will be having, while buying one product, you will be having a combination of products. Okay,
So necessary accessory products may be along, maybe supplying along with that, and you will be having a different price along with the same. Suppose if you are buying for a floor cleaner and all, that time you will be getting maybe Harpic, floor clean, and some other products which are related to that. So almost similar kind of products you will be finding in the same. Okay, so you'll be having accessory products also along with that. Then captive product pricing products that must be used with the main product. Okay, so again this is also related to the second one, but again um, main product and maybe maybe complementary products will be there along with that. Okay, not substitute, complementary. So these products will be giving together. Okay, by product we have seen pricing low and value by products to get rid of them. That means by products will be given along with that. 1 second. Okay. One second. Then product bundle pricing. So this is what I told. This bundle of products will be kept together. Sometime in supermarket and all, you might be seeing bundle of products will be kept in one, not in basket, one packet and all. So you'll be getting all those things together. Okay, so all together one offer price will be kept. We considering the MRP, all those things. Okay, so these are the different types of pricing for the maybe the product mix. Okay, so again more explanation examples you can find in the textbook. You can just go through it, but you should not miss this particular part. So these are the things which are there in the unit 3. Unit 3 is very short, but again so many things are there, especially with related to pricing objectives, pricing policies, pricing methods, and new pricing and existing products. How we can do with the product mix and all pricing. So how it is related to product life cycle and all. So these are the things we plan for the unit 3. So that much only there in the unit 3. And as we said for the case study part, I think yesterday Vijay, you were also requesting, right, for the case study part.
Yes, sir.
So today I kept that case study 1 in the syllabus, okay, in the PPT, so that we'll see how case study can be discussed. What are the strategies we should follow while going for the case study analysis? Okay, I hope that will be helpful. We will not be able to discuss all the case study, at least how it is happened or how the case study will be taking place. We will be discussing. Okay, hope it is fine even for others, because how what are the strategies we'll follow for the. Yes, Nandini, is it confirmation or you are having any questions? Fine. Yeah. Okay, so let me see. I kept the case study in the last slide. So all the case study we can have one common strategy. That strategy I will just explain. Okay, so these are the maybe things you should not. Okay, you should not while doing the case study. First of all, we should read and understand the case study. Okay, so case always will be giving very long passages. It will be very long paragraph will be there. First of all, what we supposed to do, even during the examination, whatever we do now, it may be an experience. That's it. But you will not get the same case study for sure for the examination. So you may be getting something different. So first of all, what we should do, we should read and understand the case. Okay, you can underline, you can just round off some maybe important problem that you identified in that, important people in that. Okay, if it is related to people and all, and even here also you can maybe underline. Okay, so understanding that particular story is very important. It's a case study, but Don't take it very complicated. Understand that story. What is that story about? Okay, how it is connecting and all coming later. Then second one, identify the problem or challenge in that particular case study. There will be a problem. Okay, we are here to discuss about the problem or challenge that you should understand. Okay, so what is the problem which is hiding behind that particular story or that particular case? This is the second stage. Then gather in relevant information related to the case. Okay, so you might be having some topics that you already studied and how it is related to that particular context. You should understand, since it is given in the after the first unit, you will understand it is related to first unit. But if it is in the examination, end semester examination, you should know how it is related to your topic. Which topic that you studied will be connected to that particular context. That we need to maybe connect in the third stage, that is gather relevant information related to that particular case or that particular challenge. Then fourth one, analyze the market environment. So that will be related to the market of the particular brand or product. Okay, so how the market factors are, internal problems will be there for the company, external problems will be there, what is the time period that they started that particular case or issue, that also need to check. Then the fifth stage, you will be checking the internal capabilities. Okay, how the company is having, or what are the challenges that company is having, what are the capacity of the particular company, all those things you need to assess. Okay, you need to check before we suggest some solution for the company's problem and all. We have to check whether they are having this and that capacity, this and that maybe abilities, this and that technical supports and all. Okay, so this is what we need to check in the fifth maybe stage. Then there may be a number of maybe alternative options, alternative solutions that you need to check in the sixth maybe step, that is identification and evaluate the alternative. This is not there in your textbook. If you want, you can just have a screenshot of this, or later once I share the PPT, you can just note this. Okay, then develop recommendations, and based on your alternative solutions, and based on the analysis that you done on the topic, you have to have the alternative maybe solutions for that. Okay, then develop recommendations and conclusion and justification. These are the stages which are commonly used for any case studies. But newer case study which are there in the textbook and all, how it is given, they didn't follow a detailed case analysis and all. There are some questions based on the passage or case study, and you have to answer for those case study questions. This is what given in your textbook. Okay, so if you are getting such kind of maybe questions, it will be little more easy comparing to doing a case analysis like this. Okay, so what you can do, you can follow all these steps, you can keep these steps while analyzing the case study and all, but see the questions which are there in the textbook. So this is the case study, you can just go through it. I will not be able to explain each and every maybe content there in the case study. We can just go through it and later we can discuss about the problem, because few of you may not be read that case study. I'm keeping some 2 minutes to read the first paragraph. Maybe the second paragraph is also given there. Then we can discuss about the solution. This is a case study one. You can go through it. Okay, then we'll start. 2 minutes I'm keeping for reading the same, because I cannot. You cannot listen to the case paragraph what I am reading here completely. Instead of that, you can go through it and we will discuss about that. The facts you can just maybe mark when it is established. who invented, what is his capacity, then how he taken the risk of maybe new wave of retailing, that too in an age of no internet or no popularity for internet. How it helpful for the consumers to buy, right? So somebody was, yes, Anil Kumar sir.
No, sir, no. It's an accident. Accident.
Anil Kumar sir.
Nothing, nothing.
Okay, okay. Okay, so how he started that particular initiative, how it helpful for the consumers, all those things you can find it in this particular slide. This is a question, okay, please understand that. How Amazon started, you can find here. What is the initial investment, right? Then what was the sales? What is the market capitalization? Right? So this is the first phase, okay, introduction phase. I hope all of you have gone through it. We'll go through the second, maybe the paragraph. What happened to after 1995 introduction part and all, right? In 2000, what happened to its total market capitalization, the loss which happened, right? Then again, he didn't lose that particular vision. How it tie-ups with the toys are used. Then how they spread their operations into different types of product, books, and other maybe toys. How it created a network traffic to Amazon.com. That means the number of people who are using the platforms, how crowded it was. Traffic in the sense, the network traffic, okay, the number of people who are using at a time. What is the biggest move? The global move, okay, that is more global. Why they spread across the world? This is the stepping stone for their development. First full year profit in 2003. And how it happened for the, see, this is happened 2004 case study, okay, 2004 only they had this case study, and how it touched the billion maybe profit. And how their perseverance, okay, created a better output. This is published in 2004, this particular case. Questions you can find. How does Amazon.com bring utility or create value for its customers? This is the first question. What do you think? You can use a chat box. How Amazon bring utility, that is the ability to satisfy customers, okay, or create value for its customers You can keep the keywords in the chat box. Okay, we can discuss it later. What do you say? How Amazon created a value for its customers? What are the keywords which are coming to your mind? How it created value or utility, satisfaction? What are the advantage of going for Amazon platform, Amazon.com? What do you think? This is the place where you will be able to have some extra effort. Okay, otherwise, yeah, all area items, that is, there is no restriction with respect to the location, right? Majority of the places are covered. Door to door delivery, right? You will be getting, that means convenience is there, right? Tying up with various toy with a lot of products, yes, according to the present maybe case, they started with that, right? So tying up with all the manufacturing, everybody is using platform for their selling part, right? Amazon found new, now people are lazy, and yes, exactly, people are not able to, or people are looking for convenience, not for the cost of their product. Convenience is more important. Digital way of marketing, wide product portfolio, yes, offering discounts, incorporation of new tech, right? Apart from that, again, the reviews are there, right? So it's giving lot of transparency for buying, users videos, right? Users reviews, click and buy products, no need go for physical shopping, yes. Deepthi, all products are available, yes. Again, offers, those who are going for online, maybe payments and all, credit card, debit card, all these offers are there. So thank you, Beena, Vijay, Murali, okay, uh, Theo. Yeah, new tech, incorporation of new technology is there, yes. Deepthi, everyone, for easy access, yes. Accessibility is very good, even without any maybe accessibility, remote access is there, right? Return of product also there, right? If you're buying from a physical shop, we have to again travel, we have to again return, there are a lot of movements, we can avoid all those things. Thank you all of you for this maybe contributions. We'll see the answers later. Okay, second, explain the marketing framework of Amazon. What marketing framework, how they market their product, what they have done, in which point they started to earn profits in all the quarters, what is the keyword where they succeeded after having a lot of loss in the beginning, from which point they started free delivery. Okay, no, as per the case study, Bina ma'am, as per the case study, from which point, tying up with all the companies, yes, Murali. Apart from that, they had a vision of global market, right? So they started to spread their operations across the world. So that is the, yeah, huge stock of various products. Again, yes, they have maybe tying up with the new products, right? Manufacturers, diversity of the product. Yes, Anil Kumar. Yes, Anindita, Manjumdar, and Anil Kumar, Murali, everyone. Yes, see, whatever we are saying is right. This is what, okay, this is the advantage of case study. Whatever we say, but we have to say justification for that. We have to find a justification. Even if you are saying something else with the right justification, you are right. This is advantage of maybe case analysis. Okay. Then last question: what do you learn about marketing from the Amazon story? What are the maybe the learning lesson that we take out of this particular success story of Amazon? What are the keywords you should keep? Tell me the keywords. Our answers should be better than the answers I kept. Vision should be the diversity of the product we already kept for the previous question. Vision, there should be a larger vision. Okay, Anil Kumar, yes, that is right. There should be a vision. I'm agreeing that. All of you will be agreeing, I hope. Then apart from that, right pricing. Okay, pricing should be there. Pricing is coming in the other unit, but again, pricing is one of the criteria. Understand the demand of the customers. That means customers' preferences and interests should be considered. What exactly the problem with the customers, right? Service first, right? What is the service? How they want? Okay, what are the things they are expecting that they have already studied? Digitization is one thing. Yes, Vijay. use of latest technology, globalization. Yes, globalization is there. Market scanning should be there. All product available at one place. Yes, convenience for getting all the products. Are we limiting our guessing here? Why all of you are limiting your maybe creativity or your innovative thoughts only to these points? Give me more points so that we can discuss all those. Convenience, we can keep it morally. All products at one place. Very convenient. Amazon is right now. Amazon started with maybe other services, digital payment, right? Service payment or banking transaction, whatever they were doing, right? Then even vegetables. Encourage entrepreneurs and small business. Yes, it's encouraging everybody, especially the new startups. They are seeing Amazon as a better platform for their products and all. Adopts latest technology. Yes, Vijay. Innovation to need maybe the cater the needs of the market. All of you contributed very maybe wonderfully. Okay, so Vijay, Beena, Deepthi, Satish, Murali, all these people, Anindita. Thank you all of you for never give up with the flop. Yes, bounce back. Okay, resilience. We can keep resilience. Okay, resilience one of the capacity that sometimes business may go down. The market is also like that. After 90s globalization, a lot of changes was there, right? But they didn't give up after having maybe losses for 8 years, 1995 onwards. They were not having a constant growth. A lot of flops was there. After 8 years, they started to grow, that too in a global market. Understanding the customer requirements, need, right? So we will see what are the ready-made answers that I already prepared. Okay, so we can just go through it. How does Amazon bring utility create? Amazon create convenience, wide variety of products, competitive pricing, click and buy model, right? So free shipping, discounts, personalized recommendations, shopping experience is better, right? All these things you can keep. You already answered better than this. Okay, this is the first question. And if you are answering with more explanation examples, you will be able to get the maximum score here. Second, explain the marketing framework of Amazon.com. So here we can customer-centric approach is there, global expansion we already discussed, partnership is already there, competitive pricing already discussed, traffic diversification, that is they have focused on different category of people, geographical expansion is also there, right? These are the things you can look for the marketing framework of Amazon. Okay, during the time. What do you learn about marketing of the Amazon? Innovation, persistence, adaptation, resilience, customer focus, right? Customer satisfaction. All these things are the maybe the things you need to remember for Amazon's case. Hope all of you are clear about this, right? See, whatever we discuss, yes, Anandita. Even products, but also for movies, payment. Yes, exactly. A variety of services. I hope whatever we discuss in the slides or maybe in the chat box is better than what I kept. This is the power of our intelligence. Okay. If you are discussing and exploring in detail, whatever is customized may be lesser than what we have already discussed. Okay. We'll come up with new cases and new discussions. This case study discussion is excellent. Okay, we'll have more discussions in the coming days. So thank you for today. Thank you everyone. I hope it has created some extra insight about the case analysis for all of you.
Yes, sir. Thank you so much.
Thank you everyone. We'll see you in the next class.
Sir, when will be the next class of yours?
I'm not sure. Weekly we are getting that updates. So we'll wherever whatever WhatsApp group you are having, even you can request one of you can text me so that I can send you the PPT there. Okay. So last year I have shared, but I didn't take part in the MBA WhatsApp group. If you are having a group, you can one of you can text me. Okay. So that I will give that maybe PPT, so you can share it among your people. Okay, so my number I kept here. If you want, you can take it, all of you. That's it for today. And I'm not sure about the number of classes. Okay, so they will share one day advance. Accordingly, I'm taking the class. Okay.
Sir, I think today is the last class as per the
No,
schedule.
is it? I am not sure. We didn't discuss everything. We have discussed only. I think 1 more hour we may get. I will check with them. If it is not there, I will share the PPT of entire units with the case studies and all.
We had a cancellation in last week because of the cyclone. I believe we have another class.
Okay, okay. If it is there, fine. If it is there, I will take. If it is not there, I will share the materials. Okay, PPT. One of you can text me in this WhatsApp number. That is my number. Okay, so I will share that
Thank you,
PPT
sir.
only. Last year also, even last year, people also use the same PPT only. You can refer the PPT for your studies. Okay. I hope it is fine. All of you. Thank you. Okay.
Thank you, sir.
Last Sunday there was no class. Yes, Anil Kumar sir. We'll see, sir. Yeah. We can use that number. You can maybe note one of you. Thank you.
Thank you, sir.
Yeah. Thank you.
Thank you, sir.
Thank you.
Good morning, students. Good morning, students.
Good
Am I
morning,
audible?
sir.
Okay, okay.
Good afternoon, sir.
Morning, sir.
Yes, it's almost good afternoon. It's 12:03. Okay, so we'll start the class again. So, in the last session, we have discussed about the cost of debt, right? Discussed about cost of debt, cost of redeemable debt, and cost of redeemable debt. So they have done a problem, and the same problem you can do with one more method. It's called shortcut method. So if the rate of interest is not given, right, whether the lowest rate, highest rate, if the interest rate is not given, in that case, for the redeemable debt, you can use this shortcut method also, right? This is a very easy method, but there will be a slight difference between the answer if you use shortcut method and the trial and error method. But both are correct. For the exam, they will consider both shortcut method and trial and error method. So in the shortcut method, you can use the equation for cost of redeemable debt. That is, cost of debt is equal to, this is cost of before tax. This is cost of debt before tax. Be equal to interest amount plus RV. RV means redeemable value or maturity value minus net proceeds, right? Divided by N. N means number of years. For how many years the bond is issued? That is 5 years or 10 years, like that. All divided by RV plus NP. RV means again redeemable value plus net proceeds. The same net proceeds divided by 2. This is the average of redeemable value and net proceeds. So you can take this value, right? You'll get cost of debt before tax. The same way for calculating the cost of debt after tax, you can use this equation. The only difference is here you have to include 1 minus tax rate, right? So interest amount multiplied with 1 minus tax rate, right? Then plus RV minus NP divided by N, all divided by RV plus NP divided by 2, right? This is what you have to use in case of redeemable debt. It's a shortcut method. You can easily calculate. If mention that we have to use method or that is right. If nothing is mentioned and the rate of interest is also not given, can use this method. And you can see the question. This is done. The problem is how right. So give you the answer here. Cost of the before taxes.
Sir, your voice is breaking.
Is it clear now?
No, sir, still
No, sir,
breaking.
your voice is breaking.
Is it clear? It is audible?
Yes, sir, you are.
Okay, fine. So what we were discussing is that, so here we have discussed about a shortcut method. For calculating the cost of redeemable debt, we have used a trial and error method. For the same problem, you can use the shortcut method also. If the rate of interest is not mentioned in the question, and if it's not clearly mentioned in the question that you have to use the trial and error method or yield to maturity method, in that case, you can use this shortcut method, right? Uh, so the equation is cost of debt is equal to interest amount plus redeemable value minus net proceeds divided by n, right? This n is number of years, so that is 5 years or 10 years like that. Number of years. Redeemable value means the maturity value. At what price you have to redeem the debt, that is redeemable value. And whole divided by RV plus NP. Redeemable value plus net proceeds whole divided by 2, right? This is RV plus NP divided by 2. Average you have to take. And this is interest amount plus redeemable value minus net proceeds. This is one equation, right? Like that you have to take. And if you have to calculate after tax cost of redeemable debt. In that case, you have to include one element, that is 1 minus tax rate, right? So interest amount multiplied with 1 minus tax rate. So I multiplied with 1 minus tax rate plus RV minus NP divided by N, all divided by RV plus NP divided by 2. So in this way you can calculate. We'll see one question and then you'll understand clearly. This is a question we have already discussed under trial and error method. Right? The same question we have discussed under trial and error method, and we'll try to solve this using the shortcut method. And here you can see that the equation is cost of debt is equal to interest amount plus redeemable value minus net proceeds divided all divided by RV plus NP divided. So cost of debt is equal to rupees. That is 14% of 100 rupees, right? 14% every year rupees 100 debenture of a firm can be sold for a net price of rupees 95.90. The coupon rate of the interest is 14% per annum, and the debenture will be redeemed at 5% premium on maturity. There is a 5% premium on maturity, and the firm's tax rate is 35%. You have to compute cost of capital. So if you use shortcut method, so how will be the answer? That's what we are checking, right? So interest amount is 14. Interest amount is 14, right? Redeemable value 100 rupees plus 5% premium. So 105 minus the net proceeds, right? The issue price or at what price you are issuing now, net proceeds divided by number of years 5, right? Then the redeemable value 105 plus divided by 2. So we'll get 14 plus 9.1. 9.1 is means that 105 minus 95.9 is 9.1 divided by 5. The 200.9, that is 105 plus 95.9 is 200.9 divided by 2. So we'll get the answer 0.15749 or 15.75 percentage, approximately 15.75%. And after tax cost of redeemable debt also you can calculate, right? Only thing you have to consider this interest amount multiplied with 1 minus tax rate. If you want to calculate after tax cost of debt, you can calculate it directly. The only thing is you have to consider this 1 minus tax rate. So interest amount multiplied with 1 minus tax rate. The same interest amount is here 14 multiplied with 1 minus tax rate. So 1 minus 0.35. 35% is the tax rate. So 1 minus 0.35. So you get 9.1. 9.1 is the interest amount, after tax interest amount. Then plus the same equation, right? RV minus NP divided by N. I'll get 9.1 divided by 5. Then RV plus NP divided by 2. You'll get 200.9 divided by 2. You'll get the same amount, 10.92 divided by 100.45. So final answer is 10.871%. But the same question you calculated using trial and error method. So that time the answer was different, right? Little different. You can see here, right? The answer was 16% and 10.4%. There's a slight difference, right? So there will be a difference in the answer, but still you can use shortcut method or trial and error method for calculating the cost of debt, right? That's what we have discussed. And yes, cost of zero coupon bond. So sometimes there are some bonds like zero coupon bond. Do you have any idea about zero coupon bond? Anybody? Okay, no idea. So zero coupon bond means the company may issue bond. Or normally when company issues bond, they will pay interest, right? The company will issue a bond, and those who purchase the bond for the debenture or bond holders, the company will give interest per year, right? So will give interest. But for some bond, there won't be any interest. So what they will do is when they are issuing the bond, they will issue at a discount. Suppose the bond value is 1,000 rupees. So you can purchase the bond at 800. But when it is redeeming, you will get 1,000 rupees. So there will be no interest. Zero coupon. Coupon means interest. So zero coupon, zero interest. Right? No interest will be getting, but you will get a discounted price when you are going to purchase the bond. When you redeem it, you will get the face value. So 1,000 rupees bond, you can redeem at 1,000, but you can purchase at 800 in the beginning. So that is called zero coupon bond. So for the zero coupon bond, how to calculate cost of debt? So the same method you can use, right? The only difference is interest is not there. Right? There is no interest. There is no interest, right? So you can see here, if you are taking 10%, Thailander method if you are using, if it is 10%, you can take. Jayanant, can you just mute if you don't have any questions? Yeah, let's start. So you can see the discount factor. If you take 10%, at 10%, 100 rupees you'll be getting at the end, right? In the question. This is the question first, right? Axis Limited has issued a redeemable zero coupon bonds of rupees 100 each at a discount rate of rupees 60, repayable at the end of 4th year. So there are 4 years, and the value of the bond is 100 rupees. Redeemable value is 100 rupees. But they are issuing at a discount of 40 rupees. Right? So it is a discounted rate, 60 rupees. So 40 rupees they are deducting. So you can purchase the bond for 60 rupees, and at the end of 4 year, you will get 100 rupees if you submit the bond. Right? If you redeem the bond. Okay? And you can see that there is no interest mentioned in this question because it's a zero coupon bond. There is no interest for zero coupon bond. Now how to calculate the cost of debt? So 100 rupees you are getting, right? The present value is 60 rupees, right? Present value of the bond is 60 rupees. So you see whether it is coming near to 60 or not. So when you discount at 10%, 0.683 is the present value factor at 10% on 4th year. Here both the cases you have to take present value factor, no annuity factors, because there is no interest, right? There is no interest. Only for interest we have used present value annuity factor. So 0.683, 100 rupees will get in the 4th year. So the present value will be 68.3. This is more than 60, right? And then if you have to increase the interest rate, so instead of 10%, you take an increase in interest rate or discount rate, it is 15%. You take 15%, right? And if you discount at 15%, the present value of the bond is 57.2. So it is less than 60. So you can use the equation, YTM equation, lowest rate 10 plus the present value at lowest rate minus the actual present value at lowest rate minus present value at highest interest rate, right? Then highest rate minus lowest rate. So you will get the before tax cost of debt. From there, if you deduct the interest tax element, because tax is not mentioned here. If the tax is there, deduct the tax element, and you can find the cost of debt after tax. And in the same place, you can use the shortcut method also, but there will be a difference in the answer. So if you use the trial and error method, you'll get a more accurate result than the shortcut method. But for the exam purpose, you can use when you know the method. Right. So far we have discussed about cost of debt, calculation of cost of debt. So next one is calculation of cost of preference capital. Calculation of cost of preference capital is almost similar to cost of debt, because in case of cost of debt we are paying interest, but in case of preference capital we are paying dividend. Both are fixed. In case of preference capital also we have to pay fixed dividend, right? So the calculation also almost same, but only difference is in case of cost of preference capital there won't be any tax element, right? Why there is no tax element? Anybody can answer if you know? In case of calculation of cost of debt, we have calculated cost of debt before tax and cost of debt after tax. But in case of cost of preference capital, there won't be any concept like cost of preference capital after tax. Why it is like that? Okay. The cost of
Sir,
yes.
please repeat the question.
In case of cost of this cost of debt and cost of reference capital is almost same, because in case of cost of debt we are paying interest. It's a fixed interest. In case of cost of reference capital we are paying reference dividend. So both are fixed. In the same way we are paying, but in the calculation of cost of debt there is two concepts like before tax and after tax. But in case of cost of preference capital, there won't be any concept like after tax. Only one cost of preference capital calculate. There is no classification like before tax and after tax. Why we are not considering the tax element in the calculation of cost of preference capital? That is the question. Why we are not considering the tax element?
So, dividend is one which the company pays to the other. It's
Yes, dividend we always pay after paying the tax, right? So after paying, it's not a tax deductible item. So after it's already after tax only, right?
Yes,
After paying all the taxes and all, whatever profit is there, right? What is the profit available after paying tax? Profit after tax. From there only we'll pay the preference dividend. So no need to consider the tax element here. You can directly calculate, right? And all other equations are same. All other equations like cost of preference capital will be equal to dividend divided by principal amount. So in case of cost of debt, we have taken interest amount. Here we have to take dividend amount. So dividend amount divided by the principal amount. Or we can say that dividend amount divided by net proceeds, right? The same equation that we have used for redeemable debentures or irredeemable debt, right? In this case, it is irredeemable preference capital. So in case of irredeemable preference capital, we can use the equation dividend divided by principal amount or dividend divided by net proceeds. You can go to the question, right? In case of cost of redeemable preference capital, what you can do is the same equation. Shortcut method we have used for cost of redeemable debt, right? That is interest. So instead of interest, here you have to take dividend. Instead of dividend, you have to take instead of interest. In case of cost of debt, what you have here, you have to take dividend, right? Dividend plus maturity value, that is redeemable value. Both are same. Terminal value, maturity value, redeemable value, all are same only. So maturity value minus net proceeds divided by n, number of years. Then all divided by maturity value plus net proceeds divided by 2. So this equation you can use to calculate the cost of redeemable preference capital, right? Here you can see one question. Just go through the question. A company issues 10,000 10% preference shares of 100 each. Cost of issue is rupees 2 per share. Calculate the cost of preference capital if these shares are issued at par, at premium, at a discount. So there are three cases, right? The company is issuing 10,000 10% preference shares of 100 each. So 10,000 is a number, and 10% is the dividend rate, right? And for one share, the value is rupees 100, and the cost of issue is rupees 2 per share. That is flotation cost is 2 per share. Calculate the cost of preference capital in three cases. If it is issued at par, what will be the cost of preference capital? And if it is issued at premium at 10%, what will be the cost of preference capital? And if it is issued at a discount of 5%, in that case, what will be the cost of preference capital? You can just calculate within 2 minutes, 1 or 2 minutes, just try. Did you get the answer? So in the first case, whether first you have to consider whether it is redeemable or irredeemable. Whether it is redeemable or irredeemable. It is irredeemable. Why? Because the number of year is not mentioned here, right? The number of year is not mentioned. So we can use the equation dividend divided by principal amount or dividend divided by net proceeds. D divided by NP. D divided by NP. Right. So at par, in the first case you see, what is the dividend amount? 10%, 10% of 100 rupees, the face value, right? So 10 rupees is the dividend divided by net proceeds, because it is issued at par. Net proceeds is 100 rupees minus cost of issue, rupees 2. So 98. So it will be 10 divided by 98. The second case, if it is issued at a premium of 10%, right? So in that case, the dividend amount will be same only, right? Dividend will always calculate on the face value. So 10% of 100, 10 rupees is the dividend divided by net proceeds. How much will be the net proceeds? It will be 100 plus 10%, 110, right? 110 minus 2. So 108 will be the net proceeds. In the third case, it is issued at a discount of 5%. So in that case, dividend will be the same, that is 10 rupees divided by 5% discount issued at 95. 95 minus 2, it will be 93, right? So that's how you have to calculate the cost of capital. You can see it here. Here in this case, we have taken the complete amount, right? 10,000 into amount. So for 10 rupees into 10,000 shares, 1 lakh. The value will be same, answer will be same. If you take for 1 share or if you take for all number of shares, the answer will be same, right? This is 1 lakh divided by 10 lakh minus 20,000. Because for 1 share, if you have to issue 2 rupees, there are 10,000 shares. 10,000 into 20,000. This is 10 lakh. That is, there are 10,000 shares of 100 rupees, right? It's 10 lakh. So 10 lakh minus 20,000 is 98. So it's actually 10 divided by 98, right? So it's 10.2%. And if it is issued at a premium, dividend will be the same. It's 1 lakh or 10 rupees. If you take per share, it is 10 rupees, right? So 10 rupees divided by 108, it is 0.92 or 9.26%, right? If it is issued at a discount, 10.75. It is the same method as in the case of cost of debt. We have calculated cost of redeemable debt that we have calculated, right? So next we'll move to calculation of cost of redeemable preference capital. You can see the question. Just go through the question. A company issues 10,000, 10% preference shares of 100 each, redeemable after 10 years at a premium of 5%. The cost of issue is rupees 2 per share. Then calculate cost of preference capital. You can see that there are 10,000 shares as in the last case, and the dividend rate is 10%, 10% of rupees 100, right? 10 rupees only. But each redeemable after 10 years. So after 10 years, it's getting redeemed. That means it's a redeemable preference capital at a premium of 5%. So redeemable value will be 100 plus 5. 105 will be the redeemable value. The cost of issue is still 2 rupees only. 2 rupees. Right? How to calculate the cost of preference capital? You can use the same shortcut method we used. Right? You just apply the formula here. Cost of preference capital, KPR. The cost of preference capital is equal to 1 lakh. Right? 1 lakh is the dividend amount. Right? 1 lakh dividend amount. 10% of 10 lakh. Right? 10% is the interest amount. sorry, 10% is the dividend amount, dividend rate, and a 10 lakh is the total amount. 10% of 10 lakh is 1 lakh, right? Then this is 105 into 10,000. There are 10,000 shares now. So one share value is 100 rupees. It is redeemed at a premium of 5%. So the redeemable value will be 105 for one share. So 105 into 10,000 will be 10 lakh 50,000. 105 into 10,000, 1 lakh 10 lakh 50,000 minus 98,000. Sorry, 9 lakh 80,000. Why it is 9 lakh 80,000? Because 10 lakh rupees is the face value, and for issuing one share we have to pay 2 rupees, right? It's flotation cost. So 2 into 10,000, 20,000, right? So 10 lakh minus 20,000 will be 9 lakh 80,000 will be the net proceeds divided by 10. This is number of years. 10 is the number of years. Whole divided by 10 lakh 50,000 plus 9 lakh 80,000 divided by 2. You will get 10.54%. Is it clear? It is similar to the shortcut method we use for the calculation of cost of redeemable debt. The same method we can use in case of calculation of cost of preference capital, that is redeemable preference capital also, right? Both are same. The only difference is not tax element we calculate in case of cost of preference capital, right? You can see one more question here, right? Because of the time constraint, we are not going to discuss about the more questions. We'll be discussing only one question. If you have any doubts, you can solve all the questions in the book, and if you have any doubt, we can discuss in the last. I think we will get one more day as discussed. Like one day we have cancelled the classes now, so we'll be getting one more day. So you may get information about that. So that time we will discuss all the questions. Right? This is our third hour, I think. For MBA, there are 8 hours normally. This is our third hour. So we need to get 5 more hours. So I'll be taking 1 more hour in the afternoon. So after that, we need 4 more hours. I think they will allot later.
In the afternoon, which chapter you're going to teach, sir?
We have to start, at least we have to complete capital budgeting next unit, unit 2. And still there are 3 more units. So we need to get 4 more hours. I think they will allot. Or otherwise, you have to go fastly and complete all the hours today itself, all the units today itself. But better, I think you'll get one more. Anyway, you'll get 1 more hour, and if possible, you may get 3 more hours. So that time we can discuss in detail. Right. So far we have discussed about the calculation of cost of debt and calculation of cost of preference capital. So next we are going to discuss about the calculation of cost of equity share capital. So as I have told in the beginning, yes, Vijay.
Sir, I don't know what is equity share capital. Please explain.
Equity share capital means ordinary share capital. Suppose in company issue mainly 2 types of shares. One is equity share and preference shares. Equity share is actually the ordinary share, normal share. So the equity shareholders will be having some voting power, right? So they'll get all the voting power. They are the ordinary shares. So equity shareholders will get a dividend only when the profit is there after paying all other expenses, after paying all interest, preference dividend, everything, right? After paying all those things, if anything is there, then only they'll get the dividend, right? So actually the company's owners are equity shareholders. Preference shareholders are shareholders or shares which have some preference over the equity shares. It's like preference shareholders will get dividend, a fixed dividend. But for equity shareholders, nothing like fixed dividend. It may change based on the profit or based on the policies of the company, it may change. But in case of preference shareholders, they will get a fixed dividend, right? And it will be redeemable. Preference shares we can redeem. But in case of equity shares, we cannot redeem. They are the owners of the company. Unless the company buy back the shares, we cannot redeem the equity shares. So there is a difference between equity share and preference share. So because of this issue, because of preference share capital, dividend is fixed now. So we can easily calculate the cost of debt or cost of preference capital. because dividend is fixed. But in case of equity share capital, dividend may not be fixed. Sometimes it will be fixed, but sometimes it won't be fixed. Right? It will change based on the profit or performance of the company. So
Sir, public shares are kind of equity shares.
yes, all the shares issued by the companies in the public stock market and all, they are equity shares. So you will get dividend based on the company policy. If they pay dividend, if you get dividend. Sometimes you won't get dividend also, right? They will retain it in the company. But preferred shareholders will get dividend anyway. And if you have voting power, that means you are holding a ordinary share or equity share.
Okay, sir, fine.
Okay. So because of this issue, right? It's not fixed. Dividend is not fixed. So because of that, we cannot use the method that we have used for preference capital. So there are different methods we use. So mainly there are three methods: dividend yield method, then dividend yield plus growth. So it's called dividend growth method or Gordon's method. It is called Gordon's growth model.
হয়েছে
Pradeep,
হয়েছে কোন
এখনো না
কোন সাইন
can
বুঝতে
you
পারছি
just
না
mute? Pradeep, can you just mute?
ওই হালকা একটু কোমর ব্যথা হালকা
ঠিক আছে গরম জল খাওয়া আর ইয়েতে
সকালবেলা উঠে গরম জল বেশি খেয়ে
আর ওটা ইয়ে করতে থাক কি বলে
Yes. So there are three methods: dividend yield method and dividend yield plus growth. It's called Gordon's growth model. Right? It's called Gordon's growth model. Then earning yield method. There are mainly three methods. Then there are CAPM method. CAPM method we will discuss after the weighted average cost of capital, because completely different method. So we'll discuss about that also. That's there in the syllabus. Right? So in case of dividend yield method, it is similar to preference dividend, right? Dividend divided by net proceeds. Same method, right? The company issues 1,000. This is the question. A company issues 1,000 equity shares of 100 rupees each at a premium of 10%. The company has paying a 20% dividend to equity shareholders for the past 5 years and expects to maintain the same in the future also. Compute the cost of equity capital, right? And it will make a difference. Will it make any difference if the market price of equity share is 160? So in case of cost of equity, that is KE, you can use either dividend divided by net proceeds or dividend divided by market price. This is applicable for preference capital also, right? If the market price is given, instead of NP, you can use MP. So market price you have to use when there's an existing share capital, right? Existing shares. Already the company has issued share. So now the shares value will be decided by the market, the stock market, right? Not by the company. When the company is going to issue the share, so company will be issuing at a price, right? So that time you have to use net proceeds. For the new shares, for a new issue of shares, you have to consider net proceeds. And if the existing shares, for the existing shares, you have to consider market price, right? That's the difference. So dividend by net proceeds for new shares, dividend divided by market price for the existing shares. So in this question, you can see there are 1,000 equity shares of 100 each at a premium of 10%. So they have issued at a premium of 10%, right? So 110 instead of 100, they have issued at 110. The company has been paying 20% dividend. The company has been paying 20% dividend, right, to the equity shareholders. So dividend amount is 20% of the face value, that is 100 rupees, right? 20% of 100 rupees, that is 20 rupees. So what will be the cost of equity? 20 divided by
1,000.
Net proceeds, not 1,000. Actually, it is 1,000 is a number of shares.
Sorry, yes.
100, not 100 also. So they are issuing at a premium. So 110. 20 divided by 110. In case of new shares. When we are considering the market price, suppose the market price is 160. In that case, it will be 20 divided by 160.
160.
Right? So it will be the cost of equity. Can you see the answer here? Right? And there is another method, that is yield plus growth method. It's also known as Gordon's growth model, right? Gordon's growth model. So in case of Gordon's growth model, we have to consider the growth. Growth means company may not be paying the dividend may not be paying the same dividend every year. So sometimes they will give a 10% increase in the dividend. So 10 plus 10% increase. So 11 rupees next year. Then for the next year again 10% increase. So 12 plus 10%. That they will give some growth in the dividend, right? Not stable dividend. Company may give increasing dividend, right? So in that case, we can use this method, Gordon's growth method or dividend yield plus growth method, right? So their cost of equity is equal to dividend, expected dividend. D1 means expected dividend divided by net proceeds, right? Expected dividend divided by net proceeds or plus growth. This is you have to add growth rate also. So yes, Abhijit, someone has raised a hand.
Sir, net proceeds means what, sir?
Net proceed means by issuing the shares, how much amount you will get, right? Suppose you are issuing a share of 100 rupees. The face value of share is 100 rupees. You are issuing at 100 rupees, right? At par, you will get 100 rupees. So that is net proceeds. Suppose the 100 rupees share you are issuing for 110. In that case, 110 is the net proceeds, not 100 rupees. Sometimes the share value is only 100 rupees, but you are issuing at 95 rupees. So 95 is the net proceeds.
Got it.
Okay. So that is net proceeds. So expected dividend divided by net proceeds plus growth rate. Or you have to consider this dividend already paid. This is the last year's dividend or previous year's dividend. Dividend paid. D0 means dividend paid. D1 means expected dividend. D0 means dividend paid in the last year because it's a growth model. We are not paying the same dividend. So sometimes in the question they will give last year's dividend and they will give growth rate. Sometimes in the question they will give current expected dividend also. So if you previous year dividend is given, you have to use this method. That is D0 multiplied with 1 minus growth rate. So if you do this calculation, D0 multiplied with 1 minus growth rate, you will get the expected dividend, that is D1, right? This is the equation you can use to calculate D1. Then divided by NP, net proceeds plus growth rate. This NP may change if suppose in the question given market price for the existing equity shares. In that case, you have to calculate, you have to consider MP, that is market price, not net proceeds, right? So either NP or MP, either net proceeds or market price, you have to consider, right? So now we'll move to the question. Just go through the question. We'll see whether we can answer or not. Just 1 minute. So what is the question? A company plans to issue 1,000 new shares of rupees 100 each at par. So issuing at par. Issuing at par means 100 rupees share, they are issuing at 100 rupees only. The flotation costs are expected to be 5% of the share price. So flotation cost means that when the company issues share, they have to pay some commission, expense, and all. There will be some expenses for issuing share. So that is from the net proceeds or from the value of the share, you have to deduct that expenses also. So after deducting the expense only, you'll get the net proceeds, right? Suppose you are issuing the shares of 100 rupees, but the expense for issuing is 2 rupees. In that case, 98 rupees only you will get, no, because 100 rupees you have issued, but 2 rupees expense is there. So 98 is the net proceeds. Like that, in this case, the par value is 100 rupees. And the flotation cost is 5%. The 5% of 100 rupees. So only you will get only 95 rupees, right? You will get only 95 rupees, even though you are issuing a share of 100 rupees. And the company pays a dividend of 100 per share initially, and the growth in dividends is expected to be 5%. Here in this case, company has not issued a share, right? The company is only planning to issue. That means there is no previous dividend. The company is pays 10 rupees dividend means expected dividend only. So expected dividend means it is D1, right? So D1 divided by net proceeds you have to take, right? So in this case, D1 is
10
10 rupees divided by net proceeds is 100 minus 5%. That is 95, right? So 10 divided by 95 plus growth rate. What is growth rate?
5%.
5%,
5%.
right? Yes. So this will be the answer.
10 by 95 by.
You can see the answer here, right? This is the question, right? This is the answer. Yeah. So 10 rupees is a dividend divided by 95 plus growth rate of 5%. So it is 0.1053. So it's 10%, 10.53%. So 10.53 plus 5%. Why it is? You can see you may have a doubt here. Right, it is 0.1053. This is 5%. 5% means 0.05. Right. If you do in that way also, you get the value 0.1553. Or if you take like 10.53% plus 5%, it's 15.53%. Right. So this is 0.05. 5% means 0.05. That is 5 divided by 100. Right. So in the second case, what is the second case? If a current market price of equity share is 150, then what will be the change? Right. If the market price increases to 150, then instead of net proceeds, you have to take market price. Instead of net proceeds, you have to take market price. Right. So instead of 95, you have to take 150. So 10 divided by 150 plus growth rate. That is 0.667 plus 5%. That is 0.05 is equal to 0.1167. That is 11.67%. This is how you have to calculate in case of growth model. Right. There's one more question you can look later. And this yield method. So another method is yield method. It's not that popular, but still for the exam purpose you can learn this method. This method more suitable when the earning per share are expected to remain constant. Earning per share means profit per share. And after paying all interest, taxes and all, if the earning available to equity shareholders is constant, the company is getting same profit for every year. And when the dividend payout ratio is 100%, whatever dividend they have, whatever profit they have, they are paying it as dividend. Right? And when the firm is expected to earn an amount on new equity share capital equal to the current earnings. So when they're issuing new share also, they get the same return, right? Same earnings. So if all these assumptions are assumptions are true, in that case, you can calculate the cost of equity using earning yield method or earning price method, right? So here you have to consider earning per share divided by net profit or earning per share divided by market price share, right? What is earning per share? Anybody have any idea about earning per share? What is earning per share? Earning per share actually means what is the earning of the company per one share. What is the profit of the company for one share, right? How to calculate it? Actually, it is the earning after paying all the expenses or earning available or profit available to the equity shareholders. Profit available to the equity shareholders divided by number of equity shares, right? So earning per share is equal to earning available to equity shareholders divided by number of equity shares. That is the equation for calculating earning per share. Now see this question. We'll see one question. So a firm is considering an expenditure of rupees 60 lakhs for expanding its operations. The relevant information is as follows. So number of existing equity shares 10 lakh. So number of equity shares are 10 lakhs. Market value of existing share is rupees 60. For one share, the market price is 160, right? The company, the share is already there. It's not a new share. We are not going to issue new share. The existing share, because the market value is 60. And net earnings is 90 lakhs. Net earnings of the company is 90 lakhs. That is earning available to equity shareholders is 90 lakhs. What do you have to do? Compute the cost of existing equity share capital and of new equity capital, assuming that new shares will be issued at rupees 52 and the cost of new issue will be rupees 2 per share. So there will be two cases. One case is we have to calculate the cost of existing share capital. In case of existing share capital, you have to use the market price per share. And another case is we have to calculate the cost of new shares, right? So when they are calculating the cost of new shares, we have to consider the net proceeds, right? What is the net proceeds here? 52 is the issue price, but we have 2 rupees cost. So 52 minus 2, 50 rupees is the net proceeds, right? So for the existing shares, you have to consider market price, that is 60. For the new shares, you consider net proceeds, that is 52 minus 2, 50, right? Now we'll see the answer. Right, this is earning per share divided by market price in case of existing shares. What is earning per share? That is total earnings or net earnings divided by number of equity shares. So here net earnings is 90 lakhs and number of equity shares are 10 lakhs. So earning per share is 9 rupees, right? Net earning is 90 lakhs divided by number of equity shares 10 lakhs. So earning per share is 9 rupees. So cost of equity is equal to 9 divided by 60. 9 divided by 60, right? We'll get 15%. The 60 is market price per share because of it is existing equity share. And the cost of new equity capital. If you calculate new equity capital, you have to consider net proceeds, not market price, right? Earning per share will be the same because that is the assumption. Earning per will be same. Earning per will be same, right? That is the assumption. So earning per share is 9 rupees divided by net proceeds. Net proceeds is 52 minus 2, that is 50. So 9 divided by 50, it is 0.18 or 18%. So you have calculated for existing shares and for the new shares also, right? So this is a calculation of cost of equity under earning yield method, right? Or earning price method. So now next we have calculation of cost of retained earnings. We have discussed about cost of debt, cost of preference capital, cost of equity. So next we are going to discuss about cost of retained earnings. As I have told, cost of retained earnings is actually an opportunity cost, right? We have explained in the beginning. So this is actually you're not paying anything for the retained earnings, but it's an opportunity cost. If you are not retained it in the business, you might have distributed as dividend to the equity shareholders. So they will invest it somewhere else. So they will get a return. So that return will be the cost of retained earnings. So that means that return will be the same return as cost of equity. But only adjustment that you have to do is the tax adjustment and brokerage, right? Sometime if you are paying dividend to the equity shareholders, the shareholders have to pay some tax on that dividend. So that they have to adjust tax. And when the equity shareholder, after receiving the dividend, they may invest. For investing, they have to pay some brokerage or commission and all. That also you have to consider. So cost of retained earnings is equal to cost of equity multiplied with 1 minus tax rate, again multiplied with 1 minus brokerage rate. So these both are in rate, in percent, right? Right? So T means tax rate, B means cost of purchasing new share. It may be brokerage or commission or anything, or transaction cost, right? Whatever it is. So in that way, you can calculate cost of retained earnings. So for calculating the cost of retained earnings, first you have to calculate cost of equity. And from that only you can calculate cost of retained earnings. For calculating cost of equity, you can use any one of the method as per the question. Based on the question, you can use any one of the method. And we'll go to one question. You can see here, a firm's cost of equity is 15% and the average tax rate of shareholders is 40%, and it is expected that 2% is brokerage cost of that shareholder will have to pay while investing their dividends in alternative securities. What is the cost of retained earnings, right? So here cost of equity is directly given 15% and tax rate is 40% and brokerage is 2%. Now how to calculate the cost of retained earnings? What is cost of retained earnings equal to? Cost of retained earnings is equal to cost of equity multiplied with 1 minus tax rate multiplied with 1 minus brokerage, right? So here it is 15%. So 15% multiplied with 1 minus 0.4, again multiplied with 1 minus 0.2, 0.02, right? It's not 0.2, it's 0.02. 2%, no, 0.02, right? You see the answer, right? So 15% multiplied with 1 minus tax rate is 40%, 1 minus 0.4. So we get 0.6. This is 1 minus 0.02. We get 0.98, right? So cost of retained earnings is 8.82. So this is how we calculate cost of retained earnings. So after calculating the cost of retained earnings, now we have to calculate the weighted average cost of capital, right? So after calculating cost of debt, cost of preference capital, cost of equity, and cost of retained earnings, now we have to calculate computation of weighted average cost of capital. What is weighted average cost of capital? It is the composite cost of capital. So also known as composite cost of capital. It is actually the cost of capital of the firm, because a firm or company will be having, right, debt, preference capital, and equity shares and all. So combining all these costs, it's the total. So why we are telling it is weighted? Because we have to give weight based on the proportion, right? Suppose the company will be having 50% equity. So that 50% weight you have to give for cost of equity and 20% preference. Then 20% weight you have to give for preference and 30% debt. In that case, 30% weight you have to give for debt. Like that, you have to give weight for each cost of capitals, right? Cost of equity, you have to give weight. Cost of preference, you have to give a weight. Cost of debt, you have to give a weight. So then you have to calculate the average, right? Weighted average, right? Hope you know this equation and all. Or we'll move to the question. We have only 1 minute, so we'll go to the question, right? So you can see the question. A firm has the following capital structure. What is capital structure? It is the proportion of different sources of finances, right? Different sources of long-term finances, or proportion of debt, equity, and preference shares capital in a total capital, right? So that's what capital structure. So in this firm's capital structure, they have debt, preference, equity, and retained earnings. And this is a proportion, right? This is the proportion. So a firm has the following capital structure and after tax cost for the different sources of funds. So cost of capital also given in this question directly. It's a simple question, right? So debt, there are 15 lakhs rupees debt, 12 lakhs rupees preference shares, 18 lakhs rupees equity shares, and 15 lakhs retained earnings. What is the proportion? It is 25%. So how to calculate the proportion? 15 divided by 60 into 100, 25%. This is 12 lakh divided by 60 lakh into 100, 20%. 18 lakh divided by 60 lakh into 100, 30%. 15 lakh divided by 60 into 100, again 25%, right? Total of these percentages will be 100 only. It should be always 100, right? This is after tax cost, right? After tax cost of debt, because when you're calculating weighted average cost of capital, always you have to calculate after tax cost of debt, right? So this is after tax cost of debt 5%, after tax preference capital 10%, after tax equity shares 12%, after tax return cost of retained earnings is 11%. This is cost of debt, cost of preference shares, cost of equity shares, and cost of retained earnings, right? How to calculate weighted average cost of capital? So what you have to do? You have to just multiply with the weight. So here the weight is 25%. That means 0.25. So 5 into 0.25 plus 10 into 0.2 plus 15, 12 into 0.3 plus 11 into 0.25. Right? That way you can calculate the weighted average cost of capital. But in the exam question won't be this much simple. You have to calculate all these after tax cost also. For this after tax cost, you have to use whatever method we have studied: cost of debt, cost of preferred shares, cost of equity shares, and retained earnings. So the next class we may discuss about one case where we have to calculate all these things, right? Yeah. So this is 0.25 into 5, 1.25, 0.2 into 1, 2. That is 0.3 into 12. It is 3.6. 0.25 into 11, 2.75. Then 1. This is total weight, right? It is 9 point. It is 9.6. So weighted average cost of capital of the firm is 9.6. So thank you, students. We will meet at 2 o'clock again for the next class, and we have to finish this, and we have to discuss CAPM also in this chapter, and after that we will move to capital budgeting. So most probably we'll complete capital budgeting by today itself. So we'll meet at 2 o'clock. Thank you, students.
Thank you, sir. Sir, in this case, this is the final answer. KW. Sir, are you there?
Yes, tell me.
Sir, in this case, KW we need to find out.
It is weighted average cost. No, this is the cost of weighted average cost of this is
Okay, that is
WACC.
KW.
WACC.
Summation of XW by sigma.
Yes. This is 1.25 plus 2 plus 3.6 plus 2.75. We get 9.60. This is WACC. WACC means weighted average cost of capital.
Okay.
Okay.
Thank you.
Okay. So good afternoon all. So I think this PPT is visible and my voice is also audible.
Yes, sir.
So Jay, do you have any doubts? Just raise the hand. I think by mistake he has raised the hand. So in the last class we were discussing about the calculation of weighted average cost of capital, right? So it's a composite cost of capital. So after calculating all cost of debt, cost of equity, and cost of preferred shares, we have to calculate the weighted average cost of capital. So based on the weight, we have to calculate. What is weight here? Here weight means the proportion. So what is the proportion of equity? And based on the proportion of equity, you have to give weight for equity share capital or cost of equity. And based on the proportion of debt, you have to give weight for the cost of debt, right? So we have done this problem. We have discussed about this problem also, right? In this problem, you can see that, so debt, there are 15 lakhs for debt. So 15 lakhs of debt is actually 25% of the total debt, total capital, right? Total amount of capital is 60 lakhs, right? Total amount of investment is 60 lakhs. And out of that 60 lakhs, 15 lakhs is debt. That means 25%. So how we got the 25%? It is 15 divided by 60. That is 15 lakhs divided by 60 lakhs into 100 is 25%. And preference shares is 12 lakhs. 12 lakhs means it is 20%. Equity shares is 18 lakhs. That means 30%. Retained earning is 25%, right? It is 15 lakhs. So 15 lakhs divided by 60 lakhs into 100, right? So we'll get 25%, right? So 15 lakhs is the 25% of 60 lakhs. So based on that, you have to calculate the proportion. That is what proportion means, right? And these are the specific cost of capitals. There is cost of debt after tax. This is after tax. Cost of debt is 5%. After tax, cost of preference shares is 10%. After tax, cost of equity shares is 12%. So this only for debt you have to calculate before tax and after tax. And for preference, equity, and retained earnings, it is always after tax only. So you don't have to do anything with the before or after tax. Right? Now, how to calculate the weighted average cost of capital? You have to multiply this 5% with 25%. So for easy calculation, what we will do is proportion we will take in points, like decimals, 0.25, 0.20, 0.3, 0.25, like that. So that we can easily calculate. So 0.25 into 5%, 0.2 into 10%, 0.3 into 12%, 0.25 into 11%. So in that way, you can easily calculate the weighted cost, right? Right? And this is it. Can you see the answer here? Right? 0.25 into 5%, 1.25. 0.2 into 10, 2. 0.3 into 12, 3.6. 0.25 into 11, 2.75. If you add all these weighted costs, you will get weighted average cost of capital. That is WACC, 9.60, right? 9.60. So when you calculate the weighted average cost, you have to multiply with the weight and divided by total weight, right? So this is each weight, 0.25, 0.2, 0.3, 0.25, all are the weights divided by, so you multiply it with the weight and divided by total weight, that is 1. Right, you'll get 9.60 only. This is how you calculate weighted average cost of capital. Now we'll see one more problem in the same way. Not in the same manner, it's a little different. Yeah, so can you just go through the question? The following is the capital structure of Saras Limited as on 31st December 2017. Source of funds, equity shares, 20,000 shares of 100 each. So total amount is 20 lakhs. 10% preference shares of 100 each. Total amount is 8 lakhs. 12% debentures for 12 lakhs. Right? And the market price of the company's share is 110, and it is expected that the dividend of rupees 10 per share would be declared after 1 year. So the dividend declared after 1 year means it's expected dividend. The dividend growth rate is 6%. Since the growth rate is given, we have to use the Gordon's growth model or dividend yield plus growth model. What does the dividend yield plus growth model is? NP plus growth rate, right? Or D1 divided by market price plus growth rate. That is the equation for calculating cost of equity. So in this case, one more condition is there. Assuming that in order to finance an expansion plan, the company intends to borrow a fund of rupees 20 lakhs bearing 14% rate of interest. What will be the company's revised weighted average cost of capital? This financing decision is expected to increase dividend from 10 to 12 per share. However, the market price of equity share is expected to decline from 110 to 105, right? 105 per share. Right. Now, how to deal with this question? So there are two questions. No, the first question, you have to calculate the weighted average cost of capital in the first one. If the tax rate is 50%, how to calculate? This is the first question. Second question, the same question, you have to add one more condition. That is, the company is going to take a loan of 20 lakhs. So one more element will come, loan, 14% loan. Rate of interest is 14%, loan will come, right? And it's for 20 lakhs. And because of the loan, what will happen? The dividend will increase to 12 and market price of share will reduce to 105. So that means there will be a change in the cost of equity also, right? There will be a change in the cost of equity also. And we'll calculate the cost of equity. What will be the cost of preference shares in this case? What will be the cost of preference shares in this case? It is 10% only, right? This is given there.
Yes, sir, 10%.
Yes, 10% is given. And what about cost of debenture?
12%, around 12 lakhs.
That is, so 12% of 12 lakhs divided by 12 lakhs. So it will be 12% only. And after tax cost of debenture, because number of year is not mentioned. So because it is redeemable. So we can use the equation for redeemable debt, right? That is interest amount divided by principal amount. Or it proceeds like that. So it is already there. So 12 lakhs only. So 12%, but this is before tax. And here is the tax rate. What's the tax rate? It is 50%. So after tax cost of debt is 6%. Right? So preference, cost of preference capital we know, cost of debenture we know, cost of equity you have to calculate. How to calculate cost of equity? It is expected dividend divided by net proceeds plus growth rate. Right? Or in this case, it is existing shares, not new shares, right? Existing shares. So dividend, expected dividend divided by market price plus growth rate. And here there is a change also, right? When the company is going for 20 lakhs loan, there is a change in the dividend and market price of share. So we have to calculate cost of equity in both the cases. So let us see how the calculation is. Can see here, cost of equity capital is D1 divided by market price plus growth rate. So it is 10 divided by 110. 110 is the market price, right? Before taking the loan. Plus 6% is the growth rate. So is equal to 0.0909 plus 0.06 is equal to 0.1509 or 15.9%, right? So after taking the loan, what is the revised cost of equity capital? It is 12. The 10 rupees has increased to 12 rupees and divided by the market price reduced to 105. So 12 divided by 105 plus 6%. So after taking the loan, the expected dividend increased to 12, right? And market price is 105, growth rate is 6. So it is 17.42. So we calculated cost of equity before taking loan, after taking loan. Now we have to calculate weighted average cost of capital also before taking the loan and after taking the loan. This is a calculation of weighted average cost of capital before raising the term loan, right? Before taking the term loan. So equity shares, there are 20 lakhs rupees, preference shares 8 lakhs, debentures 12 lakhs. It is asked given the question, right? Now proportion we have to calculate. How to calculate the proportion? It is 20 lakhs divided by 40 lakhs into 100. That is 50%. 8 lakhs divided by 40 lakhs into 100. That is 20%. 12 lakhs divided by 40 lakhs into 100 is the 30%, right? These are the proportions. This is how you calculate proportion. Now, cost of specific source of finance, right? Cost of equity, 15.9, we have calculated. Cost of preference, 10%. Cost of debentures, 12%. This is before tax. And after tax, from equity, cost of equity, you don't have to deduct any tax elements, right? From cost of preference shares, you don't have to deduct any tax elements. Only from the cost of debentures or cost of debt, you have to deduct the tax element. So 50% is the tax. So 12 minus 50%, we have only 6, right? So now we have to calculate the weighted cost. How to calculate weighted cost? Proportion 0.5 into 15.09. It is 7.545. Then 0.2, 20% means 0.2. 0.2 into 10, it is 2. That's 0.3 into 6. So you have to always multiply with after tax cost. Don't multiply with before tax cost, right? This is you have to use only for calculating the after tax. After that, you have to forget about this. Only you have to take after tax cost. So proportion at after tax cost. So 0.8, we get 11.35. That is the weighted average cost of capital before raising the term loan. Before raising the term loan, right? Yes. I hope there is no doubt. So we move to the next topic. Yes, there is one more calculation I forgot. It's a computation of revised weighted average cost of capital after taking the long term, right? So the company is going to take 20 rupees loan, 20 lakhs rupees loan at 14% rate of interest. At 14% rate of interest, right? So equity shares as it is in the question, 20 lakhs is there, and preference shares as given in the question, 8 lakhs, debentures as given in the question, 12 lakhs. Then the additional loan, that is 20 lakhs, right? Additional loan, 20 lakhs, right? So here you can see the proportion, right? 20 lakhs, this is 20 lakhs divided by total amount is 60 lakhs. So the earlier, can see that before taking the loan, the total amount was only 40 lakhs, right? Total investment was only 40 lakhs. After taking the loan, 20 lakhs also increased, right? So it is total 60 lakhs. So now the proportion will be for equity shares 20 lakhs divided by 60 lakhs into 100, right? And for preferred shares 8 lakhs divided by 60 lakhs into 100, and for debentures 12 lakhs divided by 60 lakhs into 100, and loan 20 lakhs divided by 60 lakhs into 100. So this is a proportion: 33 percentage, 13 percentage, 20 percentage, 33.34 percentage, right? So this is a before tax cost, right? Equity shares we have calculated there at the beginning, right? And preference shares, there is no change. This has changed because the market price changed and dividend also changed. And debentures also there is no change, 12 percentage. Term loan, it is nothing is mentioned about the redemption. So it's 14 percentage only, or it's redeemable, right? So 14 percentage. And after tax, equity no change, preference no change, debentures not change. So loan, debentures will be changed, 12 percentage, and 50 percentage 6 you have to take, and loan 14 percentage will be deducted to 7 percentage, right? Then weighted cost proportion 0.33 into 17.43, 5.81, 0.13 into 10, 1.33, right? 0.2 into 6, 0.12, 0.33, 34 into 0.7, 2.3. So total weighted average cost of capital will be 10.67. So this is how you calculate WACC, right? Just think whether you're clear or not. If you're in doubt, you can ask. Okay,
Sir,
so
this question answer seems to be very clear. And before tax cost percentage, after tax cost percentage, I was couldn't able to correlate. Could you please show the question once, please?
which one? This one.
Yes, sir. Before tax and after tax.
So here you can see the question here. The tax rate is 50% now. So for cost of equity, cost of preference, there won't be any change even before tax and after tax. But we will consider tax in case of cost of debt, cost of equity and cost of preference. But in case of cost of debt, you have to consider tax element. So for cost of debt, you have to calculate after tax cost, right? You can see the equity for the before raising the loan, it is 15.09. After raising the loan, 17.42. That's how we have taken here. For equity, 15.09. So there is no difference.
Okay.
Before tax or after tax, 15.09 only. The
Okay.
preference also 10%, there is no change. But debenture will change in the first case. So only debenture is here before the loan, right? So 12 will be changed to 6. 50% tax will go.
Okay.
But in case of revised weighted average cost of capital, so there loan element is also there. So after taking loan, also loan is also there. For
Yes.
loan, the cost of debt is 14%. So loan debenture both are debt only, no? So cost of
Yes.
debt only. So 14% will be reduced to 7%. 50
Yes.
percentage tax
Loan is
rate.
also kind of debenture. Correct.
Yes. So that's how it will become 6 and it becomes 7.
50% of taxation has been.
Yes.
Got
Yes.
it. Got it. Got it. Thank you.
Oh. So now we'll discuss about capital asset pricing model. Right. This in your syllabus it is there. For calculation of cost of equity, either governance approach or governance growth model and CAPM is there, right? So CAPM is one of the methods to calculate the cost of equity. That's developed by Sharpe, Linder, right? Sharpe and Linder. So Sharpe Linder model is also known as Sharpe Linder model. Trainer is also there, right, in the formulation of CAPM model. So there are some assumptions where we can apply the CAPM model, capital asset pricing model. The capital market should be highly efficient. No investor is large enough to affect the market. Right, have some expectation of risk and return. So all our expectations of risk and return. Investors are rational. So investors are rational and negligible
Sir,
restriction.
your voice is not audible.
Sir,
Could you
you
speak
are not
louder?
audible properly, sir.
Okay.
Sir,
Is it
sir,
is
you
it
are
okay
not
now?
audible properly.
Is it okay now?
It's
Yes, sir.
fine now.
Yes, sir.
Okay.
Now it
Okay.
is.
Thank you. So CAPM model was developed by Linder and Sharpe, and Trainer is also there. It was developed in early 1960s. So it's also another method to calculate the cost of equity. So there are some assumptions where you can apply the CAPM model. Assumptions are given there. The capital markets are highly efficient. No investor is large enough to affect the market, and all investors have the same expectations. And investors are rational, and there are negligible restrictions in the investment. There are two types of investment opportunities, right? Risk-free and market follow common stock. These are the assumptions. So we don't have to worry about this theory and all. The CAPM most probably only problem will come. So now how to calculate the cost of equity as per the CAPM model? It is very simple. The cost of equity is equal to RF plus beta multiplied with RM minus RF. Here K in is cost of equity and RF is the risk-free rate of return. What is risk-free rate of return? Risk-free rate of return means, but instead of investing in the dividend or equity shares, suppose if you are investing in the bank or government securities, what type of or what is the amount of return that you will get? What is the rate of return that you will get without taking any risk? Because with government securities or bank, there is no risk. It is sure that you will get the return back. You will get the interest. That is a risk-free rate of return. So normally known as the government securities or treasury bill, right? Treasury bill and all. If you invest, what is the rate of return for that treasury bill? Or if you take bank interest, if you're investing in the bank, you will get 8.5% or 7.5% return. So that is the risk-free rate. Without taking any risk, you will get a regular return. That is risk-free rate of return, right? Plus beta. Beta means systematic risk, measure of systematic risk. How much effect the market is having on the particular share is known as beta. So this cost of equity will calculate for each type of equity shares. If you take one company, so we are calculating the cost of equity for a particular company, So how much impact the market movement have on the value of the particular share is known as beta, or on the return of the particular share is known as beta. So it's simply the impact, how much impact the market movements have on the return of the share. Suppose the market return increases 10%, then how much increase will be there in the return of the particular share? It's known as beta. Suppose beta is 1 means when the market increases by 10%, there will be a 10% increase in the share value also. Right. Suppose the beta is 0.5, in that means when the market increases by 10%, there will be only 5% change in the value of the share. So that is called beta, the impact, how much impact it is having. Then RM. RM means market return, the normal return in the market, right? Then RF, the same risk-free rate of return, right? So K is equal to RF plus beta into RM minus RF, right? So this RM minus RF is the risk premium, that extra return you're getting from the market other than or more than this RF, right? Extra return that you're getting from market more than this risk-free return. It's called risk premium, right? Multiply with the beta, the impact also you have to consider, right? So we'll move to one problem. I can easily understand. So there is one question, right? From the following information, determine. So this is you have to don't consider this. From the following information, determine the cost of equity capital using CAPM approach. The required rate of return on risk-free security is 8%. Required rate of return on market portfolio investment is 13%, and the beta value is 1.6. How to calculate cost of equity? Can you calculate cost of equity in this case? Required rate of return is 8%. Market return is 13%. And firm's beta is 1.6. Cost of equity is equal to RF, risk-free rate of return, that is 8%, plus beta 1.6, right? Beta is 1.6. So 8% plus 1.6 multiplied with RM minus RF, that is 13% minus 8%, right? You can see the answer, right? So 8% plus 1.6 into 13% minus 8%. This will be 5%, right? This will be 8%. So 5% into 1.6, right? 5% into 1.6 plus 8%. It is 8 plus 8, 16%, right? 0.16, that means 16%. This is how you calculate cost of equity according to CAPM method, capital asset pricing model, right? And here also you can see one more question. If the risk-free rate of return and the market rate of return of the investment is 14% and 18%, calculate the cost of equity capital if there are three situations: beta is equal to 1, beta is equal to 2 by 3, and beta is equal to 5 by 4. And how to calculate the cost of equity? So risk-free rate of return is 14%, market rate of return is 18%, and beta is changing, right? So if you want to note, you can just note the beta values: 1, 2 by 3, and 5 by 4. So there are three cases you have to calculate. We'll see the answers. The first case, beta is 1. When the beta value is 1, it is 14% plus 1 into 18 minus 14%. So 14% plus 4%, you will get 18%. Second case, when the beta value is 2 by 3. So it is 14% plus 2 by 3 into 18% minus 14%. Right? It is 14 plus 2.66. It's 16.67%, right? Then third case, when the beta value is 5 by 4. So cost of equity is equal to 14% plus 5 by 4 multiplied with 18 minus 14%. So it is 14% plus 5%. It is 19%. This is how you calculate cost of equity according to CAPM model, right? This is the case, and we'll discuss at the end. Possible, we'll move to the next unit. At least you have to complete half of the unit today. Do you have any doubts on the unit? We have completed only the first unit within this 3.5 hours. Now we have to go a little faster, then only can complete all the units and discuss the questions. All right, so next unit is capital budgeting. I think all of you have gone through the syllabus and all of you have gone through these topics under capital budgeting. Then only you can understand, because we are discussing very fastly, and if you have not gone through these things, then it will be very difficult to follow us when we are taking the classes. So, is there anybody who can explain what is capital budgeting? Is there anybody who can explain what is capital budgeting is?
Investing in long-term assets.
Yes, it is led to investment in long-term assets, right? It is simply, the definition is, it's the process of taking investment decisions in the long-term assets, right? We have discussed that there are three financial management decisions. There are three financial management decisions: financing decision, investment decision, and dividend decision. In the financing decision, we have to decide about the capital structure, the cost of capital, all those things, right? That is from where you have to raise fund, how much fund you have to raise, all those things will be decided in the financing decision. Next important decision is investment decision. Investment decision, you have to decide about whether you have to invest in the fixed asset or current assets, right? And how to manage the current asset and fixed asset. So management of fixed asset or non-current asset is related to capital budgeting. Or capital budgeting is related to management of fixed asset. And working capital management is related to the management of current assets and liabilities, right? So when you are taking investment in a fixed asset, you have to be very careful, right? Why you have to be very careful? Because it is having huge cost, right? The investment in the fixed asset will be huge amount. We lakhs or crores of rupees will be investing for long term, and it is for long period. And if you make any mistake in the decision, it will affect the business for a long period. Right? It's a high degree of risk is there, and it will affect the future competitive strength, and it will be very difficult to take a decision, right? Based on the you have, because in case of current assets, you are expecting the return within 1 year, right? But in case of long-term assets, you are expecting the return for a long period. So it's more uncertain what will happen in the long period, right? It's very difficult to take the decision, and it's having long impact and affect the cost structure itself, right? Suppose you're purchasing the asset for lease, or you're taking the asset for lease, or whether you're purchasing. If you are purchasing, you have to pay a full amount, right? And purchase, or if you are taking for lease, then you have to pay only lease rent. So it will affect the cost, the total cost of the business, the maintenance cost or running cost of the business, based on the long-term decision, long-term, or based on the decision on investment in the long-term assets, right? It is irreversible or irrecoverable. Once if you invest, you cannot reverse the decision, right? Suppose purchasing land and consider building there, and after that, reversing the decision is very difficult, right? You cannot get the money back unless you sell it, right? So that is the issue. It is irreversible in nature. These are the importance of capital budgeting. So capital budgeting means the process of making investment decisions in the fixed asset. The process of making investment decisions in the fixed assets. So importance also we have discussed the same thing. And yes, capital budgeting process. So the capital budgeting include 6 steps, right? The management of fixed asset includes 6 steps. First one is project identification and generation. So here fixed asset means not only the asset, sometimes project also, right? A new project, in the new project also you have to invest, right? Huge amount in the beginning. That is a fixed investment or a fixed asset, right? So first what you have to do, you have to identify different alternatives, right? Instead of directly going and investing somewhere, you have to identify alternatives and generate different alternatives. Identify or generate alternatives. Then you have to screen it based on the availability of fund and feasibility, or whether we can do the business or not. And they can just screen it and select the screened one. After screening, select some alternatives. And out of the selected alternatives, you have to use some tools to evaluate which one is the best, right? Out of the selected alternatives, you have to decide which one is the best alternative. So there you have to apply some tools or methods And methods are known as capital budgeting methods or methods of capital budgeting. It is also known as investment appraisal techniques. Investment appraisal techniques. So there you have to apply some techniques to evaluate whether a project is a profitable one or not. Right? If you are having huge amount of fund with you, enough fund if you have, then you can invest in the all PCP projects, right? All profit making projects. But if you have a shortage of fund, or if you have only limited fund, in that case, you have to select the best projects, right? Even if you have a number of profitable investment opportunities, you have to select the best among them, right? So that you have to decide during the third stage, evaluating and assembling investment proposals. Next step is selection of the project, then implement it, then performance review, whether it's working as per the plan or not. You have to review, right? So what are the factors that affect the capital budgeting decisions? It is availability of fund, utilization of fund, urgency of the project, right? Suppose the project is urgent, you may not analyze, or you may not go for evaluation and all. You will implement it as soon as possible, right? So like if any disaster comes, if you want to construct a bridge, that time you want to go for different alternatives. The main is to construct the building, bridge, right? So like that, you'll go for urgency. Based on the urgency also will change. It will affect the capital budgeting decisions. Then expectation of future earnings. Cost of capital, right? Cost of capital is a criteria. When you are investing somewhere or long-term projects, it should minimum earn a return which is more than the cost of capital. Then only you can pay to the equity shareholders, dividend shareholders, and all. No, right? If you are taking a loan for a loan at the rate of interest of 10%, if you're taking a loan for 10% and investing and the return is only 8%, in that case you cannot pay the interest for the loan, right? Your return is only 8%. How will you pay for the debenture, or how will you pay for the debt? So it's a criteria. Cost of capital is a criteria for selecting the project, right? So these are the factors that affect the capital budgeting decisions. So in order to take a capital budgeting decision, or in order to formulate an investment appraisal technique, so we need some information regarding the estimated profit, right? Estimated profit and the estimated cash flows, right? Cash inflows and the initial cash outflow. Initial cash outflow here means the investment in the beginning. That is the cash outflow. That is investment. Initial investment. That is cash outflow. Suppose you are investing in a project. That is the initial cash outflow. Then annual cash inflow will be there. Every year you will get a cash inflow, right? It's like a profit. You get every year cash inflow. Then at the end of the project, if you sell it, right? Suppose the project is having a life of 10 years. After 10 years, the project will be having a life of 10 years. And after 10 years, if you sell the project, you may get some amount, right? Some value, a residual value. So that is the terminal cash inflow. So cash inflow will be two types: annual cash inflows and terminal cash inflow. So most of the cases, terminal cash inflow will be very minimal amount, so we won't consider. So the main consideration should be given for the initial cash outlay and annual cash inflows. The next thing you have to consider is required rate of return. That is the cost of capital. Is the cut-off rate or cost of capital. Then other information like the economic life of project, how many years we can run, and how much fund we have, right? And the risk of obsolescence and all. You have to consider, right? So how to calculate the cash inflow? Cash inflow and profit are not the same, right? Profit of a business and cash inflow of a business is not the same. Cash inflow means how much cash is coming to the business, right? Profit means how much profit comes. So that means income minus expenses, or if you deduct expenses from the income, you will get profit. So in the expense, you'll be having cash expense and non-cash expenses, right? Non-cash expenses like depreciation and all. So income after paying all the cash expenses is known as cash inflow, right? Without considering the non-cash expense. So you can see the equation here. In the calculation of cash inflow, we have sales minus cash expenses, right? Then you have to deduct depreciation. Depreciation is a non-cash expense because depreciation you are not paying anything. Now for depreciation you are not paying anything to outsiders or to anybody, right? Depreciation is just deducting from the income for the wear and tear of the asset, right? So by the use of asset, the value may decrease. So that amount you are deducting every year. It's called depreciation. You are not paying anything for that. So it's a non-cash expense. So after deducting cash expenses, you deduct depreciation. After deducting depreciation only, you have to pay the tax, right? So tax should be paid on the profit after depreciation, right? Profit after depreciation, but before tax. Then you have to pay the tax, you will get profit after tax. After calculating the profit after tax, you have to add back the depreciation. Why you have to add back the depreciation? Because you deducted this non-cash expense here. So you don't have to deduct non-cash expense from the income to calculate cash inflow. So you add back the depreciation again. Then you will ask why you deducted it in the beginning. Because to calculate the tax, we should deduct all the expenses, including non-cash expense, that is depreciation. And after deducting tax, again we have to add back depreciation. So we'll get cash inflow. Right? Then what is cash outflow? That's the investment cost, the value of the project, right? Price of the asset or value of the project, plus transportation cost. Suppose you are purchasing a machinery, so machinery price will be there, and to bring the machinery from the factory to our plant, to bring the machinery from the supplier's place to our plant, there will be additional transportation cost. That also you have to add with the outlay, cash outlay. Then working capital, so maintenance cost, right? Repair and all you will do for increasing the performance of the business. You have to consider that also, right? So if you add all those things, you'll get cash outflow. So cash inflow and cash outflow. Cash inflow is not the same as profit. You should know that. Then only you can do the problems. So when we discussed about the capital budgeting, the process of capital budgeting, there are different steps, right? First, you have to identify the project, then you have to screen it, and the third step is evaluating. To evaluate the investment appraisal or to evaluate the investment alternatives, we should use some techniques. This is known as investment appraisal techniques, or it is also known as methods of capital budgeting, right? To evaluate the investment alternatives. It includes discounted methods and non-discounted methods. So non-discounted methods include traditional methods, and discounted methods is also known as modern techniques, right? Modern techniques. So in discounted methods, we have mainly two models: payback period and average rate of return. This average rate of return is also known as return on capital employed, or it is also known as return on investment, and it is also known as accounting rate of return, right? Accounting rate of return, average rate of return, return on investment, return on capital employed, all are same only. Then under the discounted models, we have discounted payback period, net present value method, profitability index method, then internal rate of return method, and terminal value method, right? These are the methods of capital budgeting or investment appraisal techniques. We'll discuss one by one in detail. So first one is payback period. Payback period means the minimum or the time period required to get the amount invested back, right? The payback period is the amount of time it takes for cash inflows to equal to cash outflows, right? Suppose you invested 10 lakh rupees. So how much year it will take to get back the 10 lakh rupees from the investment? That is the payback period. How to calculate that? This initial cash outlay of the project divided by annual cash inflow. If you are getting every year same amount of cash inflow, you can easily calculate. Suppose you are investing 50,000 rupees. You are getting cash inflows of 10,000 for the next 1 year onwards for 10 years, right? So you get 10 years, 10,000 rupees every year, and you are investing only 50,000. So what will be the payback period? It is 5 years, right? So 50,000 divided by 10. That is 50,000 is the initial investment of the project divided by annual cash inflow 10,000. 50 divided by 10, 5 years. Within 5 years, you will get the money invested back, right? There are some advantages and disadvantages. You can just go through it. So the main advantage is very simple, right? All those things. But when disadvantages is not considering the value of time, right? Time value of money, considering, and right, the post payback period returns not considering, right? All those things are there. Can just go through that. And there are some small questions, right? Can just go through the question. Can you just read the question? And yes, answer is also there. Right. So a project cost rupees 1 lakh and yields an annual cash inflow of 20,000 for 8 years. Calculate its payback period. It's very simple, right? So 1 lakh is the investment, initial cost. 20,000 is the annual cash inflow. So 1 lakh divided by 20,000. It is 5 years is the payback period. This is how you calculate payback period. But sometime what will happen? The cash inflow won't be equal. There will be changes in the cash flow, right? You can see in this question. You can see in this question, payback period for a project which requires a cash outlay of 10,000. Right? In the initial cash outlay is 10,000 and generates cash inflows of 2,000, 4,000, 3,000 and 2,000 in the first, second, third and fourth year. First year 2,000, second year 4,000, third year 3,000 and fourth year 2,000. Then in this case, how to calculate the payback period? So what you have to do, you have to calculate, you have to add all the cash inflows. In which year it is getting 10,000, that you have to find. So you add 2,000, so 1 year, 4,000, 2 years, 3,000, what's the total? 2 plus 4, 6 plus 3, 9. Within 3 years you got 9,000. So you need one more 1,000, right? 1,000 more you need to make it 10,000. But for the fourth year, you are having an income of cash inflow of 2,000. Because you don't want the complete 4 years, right? You want only 1,000 rupees. That means 3 plus 1,000 divided by 2,000. So 3.5 years, right? So the payback period is only 3.5 years. You can see the answer here. Right. So 1, 2, 3. For 3 years you got 9,000. You need 1,000 rupees more. And 1,000 rupees divided by what is the cash inflow in the next year? It is for 2,000 rupees, right? So 1,000 divided by 2,000, 0.5. So 3 year plus 0.5, 3.5 years. 3 years and 6 months are required to get money invested back. Right? This is another calculation. But in this calculation, the problem is profit is given there, right? A project cost of rupees 5 lakh and yields annually a profit of rupees 80,000. Profit amount is given after depreciation of 12%. Is after profit after depreciation, but before tax. But what is cash inflow? Cash inflow is actually profit after tax but before depreciation. But here it is given profit before tax and after depreciation, right? So what you have to do? Here it is given like profit after depreciation before tax. So what you have to do? You have to deduct tax because the profit is after depreciation. So you don't have to deduct depreciation again. Only one time you have to deduct depreciation. No, so it's after depreciation. So take the profit 80,000. From that you have to deduct tax. What's the tax amount? 50%. From the 80,000 you have to deduct 40,000. So 40,000 is the profit after tax. Then you have to add back the depreciation. What is the depreciation amount here? It is 12%. 12% of what? 12% of 12% of anybody?
5 lakh.
Yes, 5 lakhs. So depreciation you have to calculate on the asset value, the value of the asset, right? So 12% of 5 lakhs. It is 60,000, right? So 40,000 plus 60,000. 1 lakh will be the cash inflow. Right, now you have to calculate the payback period. You calculated cash inflow, it is 1 lakh, and project outlay is, initial outlay is 5 lakhs. What will be the payback period? 5 lakhs divided by 1 lakh. It is 5 years, right? This is how we calculate the payback period. right? So you have to be very careful when going through the questions. You have to check whether profit is given or whether the cash inflow is given, or whether profit after tax and before depreciation is given, or profit after depreciation before tax is given. Both you have to go through, and you should be very vigilant while reading the question, right? So this will be applicable for all other methods. In all other methods also, we'll be using cash inflow only, not profit, except the accounting rate of return or average rate of return. So in case of average rate of return or return on capital employed, or it's also known as return on investment, only in this method we use profit for calculation. In all other methods of capital budgeting, we use cash inflow. That is the difference between accounting rate of return and other methods. In case of accounting rate of return method, it is also known as return on capital employed. It is also known as return on investment. It is also known as average rate of return. So in this method, we use profit, not cash inflow. In all other methods, we use cash inflow, right? So here what you will do is you calculate the average profit, estimated average annual accounting profit divided by estimated average investment. For ROC, there are so many equations. So we'll be discussing 3 more equations. So the most popular equation is the average profit divided by average investment into 100. This is the return on capital employed. There is another equation called estimated total profit divided by total initial investment. Or another equation we can use estimated average profit divided by estimated initial investment. So average profit divided by total investment also another equation for return on investment. You can use any one of this, but most popularly used equation is this, right? That is estimated average annual accounting profit divided by estimated average investment. Average investment means total investment, that is initial investment plus dispersed value, right? When you dispose the project, what is the amount that you get? That you have to add, then divided by 2. That is average investment, right? This is how you calculate return on capital employed. You'll see one question here. Yeah, there are some advantages and disadvantages. You can just read. So mostly it is accounting rate of return. It's quick and simple to calculate. All those things are there. You can just go through that. I won't be having time to read that. This is very simple, right? And this is a calculation. You can see one question here. A company has a target return on capital employed of 20%. So our target return is 20% for its capital investment. And now considering the following project, right? The capital cost of the asset is $80,000, estimated life 4 years, estimated profit before depreciation, right? Profit before depreciation, $20 for first year, $25,000 for second year, $35,000 for third year, $25,000 for fourth year. The capital asset will be depreciated by 25% of its cost every year, right? And will have no residual value. And you are required to assess whether the investment opportunity should be taken or not. Or assess whether the project should be undertaken or not. So we can use ROC here because the question is mentioned that return on capital employed, they are expecting 20%. So we have to calculate the ROC for this question and check whether it is more than 20% or less than 20%. If the ROC is less than the expected ROC, then you should not take the project. If the ROC of the project is more than the expected 20%, then you can select the project. That is what we have to do. Right? You see the answer here. Right? A company is have a target return 20%. So in this case, first year profit before depreciation is given the question, right? $20,000, $25,000, $35,000, $25,000, and total is $105,000. Depreciation is given in the question that 25% of the asset every year. So the asset value or the investment amount is 80,000. So 25% of 80,000 will be deducted every year. So it is 20,000, right? So depreciation amount 20,000 for all the years is straight line method. Same amount of depreciation for all the years, right? Then profit after depreciation. That is the actual profit, right? You have to calculate profit after depreciation. If tax is given, you have to consider tax also, right? Right? Yes. So 20,000 minus 20,000 profit for the first year is 0. Then 25,000 minus 20,000 profit for the second year is $5,000. 35,000 minus 20,000, 15,000. 25,000 minus 20,000 here, it is 5,000. So for the first year's profit is 0, second year profit is 5,000, third year's profit is 15,000, fourth year profit is 5,000. Total profit is 25,000, right, for 4 years. What is the average profit? It is 25,000 divided by 4. So average annual profit is 25,000 divided by 4. It is 6,250 the average annual profit. What is the average investment? It is 80,000 plus disposal value. No disposal value is there, so 0. So 80,000 plus 0 divided by 2. So 40,000 is the average investment. So average annual profit, average investment. So average annual profit divided by average investment, 6,250 divided by 40,000. It is equal to 15.6%. 15.6% is the average annual profit, right? Average annual return. 15.6% is the average annual return. It is also known as accounting rate of return or return on capital employed or return on investment, right? This is how you have to calculate ROCE. Is there any doubt? You can go through many other problems and be easy for you to understand. We don't have time to discuss many problems in the class because for one unit we are getting maximum 1 hour only, right?
Yes, sir.
So it's already 2:50, I think. Better we stop and discuss net present
Sir,
value. Yes,
kindly share the first chapter PPT with us.
yes, I will share. If you mention the mail ID, I'll share the PPT with you. You can mention it in the message. Anybody else have
Done,
any
sir.
doubt? You can, okay. Anybody else have any doubt? You can ask. We have 2 more minutes. I think there is no doubt. So, thank you, students.
Yeah. Good afternoon, all of you. So we'll
Good
move
afternoon, sir.
on to the other topics. So the screen is visible.
Yes, sir.
Yeah, thank you. So we are at manpower planning over here. So manpower planning, we are referring to as the a regular or as well as the frequent approach or activities or one of the operations of the human resource manager, because the reason is according to the requirement of the work or whatever the work that we are currently dealing with or the operations that we are dealing with, that may be in the form of the projects, that may be in the form of the current demand production or any other departmental requirements. So according to that, so what is whether the skill as well as experience or the talent pool is sufficient or not. So this is an ongoing process. So that is why the whether the current employees who we have currently right now, that we if we refer as a skill and experience in the terms, then the current skill set or the experience is sufficient or enough to fulfill the it means the requirement of the manpower or not. This is point number one. Second point that we have to look at, that is the what will be the requirement of the skill set or the experience in the future. Okay, maybe that may be a short term as well as the long term. So in both cases, that then according to that, are we ready, or whether the skill set, it means even after 6 months, what the requirement of the skill set, so that do we have that skill set with us? If yes, then it is fine, but if not, then how you are going to fulfill that gap. Okay. Similarly, even in the long term. So in order to fulfill the gap, so we should know that what is a gap that is existing. Okay. So that is why the manpower planning is required over here. So it's always, as we're saying, because the planning itself a future course of action. So it with respect to the talent pool that we are going to deal with. Okay. So even if we look at the definition also, it is also, it also explains the similarly, that is manpower planning is a systematic strategy, stating that it's a systematic strategy to ensure an organization that has the optimal number of employees with the required skill and achieve its objectives. Objectives in the sense the requirement of the demand that we have for the maybe in terms of production, okay, maybe in terms of some operations over there. So in order to perform the tasks or the work, so do we have the sufficient talent or not? So in order to fulfill that gap, we have to identify, do we have any existing gap? So just it is, or else I would say that it's a simply a comparison between the present skill set as well as the expected or a required skill set that we have, so that we need to identify the gap over there. So why we have to prefer, so there are a few things that we can discuss, like it ensures the workforce availability. Okay, so it means to ensure that the appropriate number of employees with their skills are available or not. So because the whether the right skill is present with us or not, in order to ensure that, we have to check, we have to go for the manpower planning, as well as it enhances the productivity. Okay, by aligning the workforce capabilities with the organizational goals. Why? Because it means productivity in the sense, it means if we, it is from the manpower planning point of view, it is quite simple that, so if we require a 50 employees and you have 30 employees currently with you, definitely that will affect your productivity. Okay, because 30 cannot compensate the 50. So therefore it means the required number of skill set is definitely required. So that is why, so if you have the appropriate number of employees, it will not only give the good performance, sometimes it is also observed that it will give the better performance. How it is possible? So in a case, if you simply try to understand a given scenario, like, so assuming that a team requires of 8 members, and you have given all the 8 members to a given particular team. So now usually when we give the all the 8 members, definitely they will give only their respective allotted workload. So definitely here there may be a possibility that somebody may go beyond their performance levels also. Why? Because you have given the proper workload over there. As per the requirement, as per the demand, you have given the equal workload. But in case if the requirement is 8 members of the team, but you have given 5 team members, then definitely the remaining gap is whatever is there. The 5 people have to work for the has to compensate the remaining 3 persons also. Definitely it will comes under the work overload. So then definitely the current work performance also get reduced when we have given the overload, because overload always leads to stress. Okay. Okay, and overburden. So that is why. But if you give the proper workload as per the requirement, then not only they will give the it means the required performance. Sometimes there may be a possibility that they may go beyond, because it is a sufficient somebody who is more capable enough and can perform better. So yes, they can simply go may perform the better than expected also. So that is why giving the proper workload is always essential, and reduces cost. Okay, prevents the cost of understaffing or overstaffing. So manpower planning, we are saying that means if we know that how many employees do we require at a given scenario, then we will come to know easily that the sufficient staff number of staff in terms of quantity we can maintain properly, so that that will not cause the over it means staffing or understaffing, not less, not sometimes more also. So that is also one point. So supports the succession planning. So it prepares for the future leaders, because how it is possible. For example, like if we are talking about the manpower planning, maybe assuming that the what will be the manpower plan that we manpower that we require after 1 year, maybe after 5 years. If you think strategically, after 5 to 10 years in a very long term, then where will be our company? What will be our company's position? And at that time, what type of skill set that we require? Not now. So about the strategic, if we simply go with the long term and strategic decision, then so now can we prepare a, or can we design a framework, or design a plan for the employees who are working currently, so that we can, if we expecting that after 5 or 6 years you may be required a HRD manager, or you may require a specific skilled employees. So now can you simply slowly incorporate the additions into the current employees itself, so that though you require after 5 years, so instead of searching for a new employee, so can we train, or can we create an environment of training and learning, and give a chance to the existing employees itself, so that they can equip and develop their skills and experience according to the future requirement, as per the requirement of the future. So then we are, it means what we are slowly trying to ensuring that yes, these people are getting trained for future. So that is what we are referring as a succession planning over there. Similarly, facilitates the adaptability. So prepares because here we are trying to prepare the what are the changes that are going to occur. So are we ready to accept that change? So we have to get prepared for that also. Not only these things, there are only few important limited dimensions of the manpower importance of manpower planning. Many maybe some other which are beneficial from the manpower planning. So how do we do it? As usually, simply we have a procedure for this, where we are simply starts with the analyzing the organizational goals to monitoring as well as evaluation. Similarly, any decision process, any particular process, it also applicable to the manpower planning. So understanding or analyzing the organizational goals, that what actually the business wants and what actually we are trying to achieve, so that we can understand that what type of the workforce requirement or manpower requirements are there. Then forecasting the workforce demand, the how much staff, it means in order to achieve the organization's objectives after 2 years or after 3 years in the future, then in order to achieve that, how much manpower or the talent that you need. And assessing the current workforce, it means that is the required or estimated manpower and the what is the current manpower. So that it means there will be a gap always. So then we are trying to identify the gaps based on those things. So then we have to, whatever is the gap, then we try to fulfill. So then we develop the action plan, so that whether the gap need to be fulfilled by the with the help of the recruitment, or maybe with the help of the training, by giving the training itself to the existing employees. Okay. Or maybe some sort of the restructuring. What would be your priority or preference according to your cost, according to your succession planning, or according to your it means the current as well as long-term job requirements. So whatever according to you the conditions of the company, yes, we can take the decision over there. And finally, whether that plan, whatever the plan that we design, is working appropriately or not, definitely we have to monitor as well as evaluate. It is not only applicable to the manpower planning, but also to the other any process, whatever whenever we are designing, because so that we can identify whether the process or the design is giving the necessary or the appropriate results as per the design or expected design or not. So whether it means, or else in other words, I would say that yes, whether we are going within the limits of the organization, or we are going out of control. Okay, so in that way we have to monitor as well as evaluate. And another topic, very frequent topic, more regularly, that we can say that is a selection as, I think, recruitment. Yeah, I think, okay. Selection. Okay, induction. Okay. So selection process. Okay. So what do you mean by selection? So selection is a process of choosing the best candidate from the pool of applicants to fulfill the specific job role. It means we are finally selecting a one particular candidate from the pool of applications. Okay. After completing the selection process, after completion of your interview, final rounds, background checkup, all those things, finally you are selecting a one particular person. So then what is the main objective? So it means the main objective is simple. That is the objective of the HRM. That is the right candidate at the right place at the right time, which is difficult to practically it means implement over there. But still we try to do that. Yes, who is the best match or the right match among the pool of applicants for a given particular job. Okay, for the job description. So according to their skills and qualifications. So mainly this selection focuses on identifying the and hiring the most suitable for, employee for a given particular job from the pool of applicants over there. So why do we go for the selection? What is the importance of this? So importance is for the effective workforce, because the company wants always the best talent. So now among the pool of applicants, we are trying to select a particular candidate who's it means having the more potentiality and more suitable to do a particular job. So that is why for the effect, it means, so it means if the more suitable, more potential is there, then the possibility of the workforce effectiveness is more. So and cost effective. So when we are saying that the cost effective, it indicates that if you are selecting the right person, so it means definitely the organization feels that the employee can work properly with the organization, and while working, so because of the match of the job description and job specification, so because the person is right, so therefore the employee understands the work and is already capable enough to perform the jobs. So definitely the performance of the employee will be appropriate. Okay. So, but in case if the performance of the employee is not up to the mark, then definitely we feel that yes, we have to either remove the employee, so that we can come up with the one more selection. We have to select the another candidate because the current employee is not performing properly. But this will increase your cost. Okay. So when we are going with the multiple recruitment procedures, then definitely that will increase your cost also. But if you select a right candidate, that recruitment cost will be reduced. In that way, if you select a more suitable candidate, so that will be a cost effective also. Okay, fine. Another one, it means for the organization success is of course, because if we select the right employee from the pool of applicants, then definitely there is a possibility that the employee of the right, because of the right employee, the performance of the employee will be most appropriate, or the required performance can be expected. So otherwise, so which we, according to the performance, that may lead to the employee productivity, as well as that can be aligned with the organization objectives. So otherwise, what happens, it means if there is a mismatch, then definitely the employee or the skill set, or the employee's understanding or the employee skill as well as experience does not match appropriately, then definitely there will be a gap between what is expected from the job and what is understood by the employee while operating and while performing or discharging their duties. Okay, so whenever this gap exists, then definitely the organization will it means that will directly affect on the employee's performance. And in case the performance is affected, definitely it further affects to the productivity as well as organization also, definitely. So another reason is legal compliance. Okay, so ensuring the process others to the labor laws, reducing the risk of discrimination lawsuits. It means if we select the most appropriate candidate, then the definitely if we go in a proper fair manner by following the rules and regulations and the guidelines of the labor laws, then definitely the other pool of applicants might feel that yes, the person is rightly appropriately selected, the procedure was right. But if inefficient candidates were got selected, then definitely the more potential candidate will definitely feel that okay, this might be the this, it means something match was happened, something was happened which is unexpected. Okay, because the candidate who was got selected is not properly a right candidate, because more potential candidates were rejected. So then there is always a possibility that the potential candidate may go and approach the court of law, okay, and expect and asking for the fair trials and for the justice. So that might be possible. So that is why if we select the right candidate who is more suitable, also reduces the legal compliances. Okay, so what is the selection process? Okay, so it starts from the job analysis and it ends with the onboarding. Okay, finally hiring the candidate and get into the workforce. Okay, so we will go with the one by one, that each and every step. That job analysis is a understanding the job requirements and the qualification. That is what I think we discussed earlier. Job description as well as the job specification. So it means what is the job description, what you are actually the requirement of the work. Okay, what type of work that you want to that you are expecting to perform at the or within at the workplace, and in order to perform that job or that work, what type of skill set and experience is required. Okay, that is your job specification. First we need to describe these two. Second thing, we have to simply attract the candidates. Okay, it means we have to maybe through advertise, means we have to come up with the recruitment strategy, that you are how it means we have to by sending mails or by posting some advertisement or by taking the support of the consulting agencies or whatever the strategy that you are adopting. Okay, so from all these things, it means you try to get the pool of applicants. So you want to reach to the potential pool of applicants, so that the who is eligible and whoever is interested can apply. So here the main purpose is to reach the potential candidates, reach the information to the potential candidates. Then once the potential candidates has applied, we have to go with the screening. Okay, review all the skill set whether they match or not, and then reject the unqualified people by specifying the remarks over there, and then we'll shortlist, okay, the candidates who are eligible, we feel that more appropriate during the screening process. And then you will go with your selection procedure. Maybe you conduct some sort of tests, and whatever the procedure that you want to conduct, maybe somebody will conduct 2 rounds, somebody will go with the multiple rounds over there, depends on the job profile, as well as the candidate job profile over there. So whatever the procedure or the process that we have designed, so that we can provide, that we can follow. And finally, anyway, we have to conduct the interviews. Okay, preferably it will be a structured interviews, but yes, it is not necessary or a rule of thumb, but yes, we may go with the both structured as well as the unstructured interviews to assess the competencies of the it means the candidate. So finally, testing will be done. That means we are administering skills, personality, and psychometric tests can be applied further. It depends on the selection procedure of the company, that how many tests that they would like to perform during in the name of the selection process. So the testing can be done over there, so that they can how they are good depending on the position, and then they can go with the background checks. Okay, where they want to verify the candidate's record, employee history, their background, their qualification, whether it is whatever the information that has been submitted to the company is need to be verified. Okay, so that need to be done. And then if everything is if they found everything is fair and good, then they will simply offer the job. And once the offer has been sent, then the employee, if the employee or if the participant candidate has accept the offer, then the offer can, it means then with the candidate can be converted into the employee, and then can be a employee of the any company. Okay, so this is how the process goes. Maybe this is a gist over there. After, it means here most of the things like in the recruitment strategies, recruitment process and selection process, this has been, I have been simply briefed it, because that depend, because that itself a separate concept, that the process of recruitment and the process of selection. So that depends on the job requirement. That depends on the job requirement and the company's policy, that what type of strategy recruitment process that they would like to follow, as well as similarly applicable to the selection process over there. And the methods of selection. Okay, there are different methods that we follow. That is one method we can follow. The application forms and resumes will be the first step to evaluate for the whether to identify the qualification and experience. And then we can go with the another method is interviews, structured and unstructured interviews and conversations. Then we can go with the psychometric test, skill testing according to the job requirement. Then assessment centers, we can come up with the series of simulations and activities based on the performance or based on the job requirement. Then go with the background checks. Even if you want, you can ask for the references. Some of the jobs will preferably ask for the references over there. So these are some of them. And if you simply go with the advantages and limitations of these things, yes, interviews, the advantage is it is more personalized, good for assessing soft skills. It means to how the employee is reacting, how the employee is behaving, how the employee is responding, all these things. But limitation is maybe it is biased, and depending on it's a subjective nature. Somebody may like the behavior, somebody may not like the behavior of the participant. That depends. So psychometric test, the advantage of this method is it is more objective. Okay, because we want to assess a kind of a personality, and it is more scientific, because already these psychometric tests, these questionnaires are already well developed through thorough scientific inquiry. So, and it is therefore it is more reliable, trustworthy to assess the personality. But sometimes it can be impersonal or relevant if not job related. So it is all about the personality, it's not about the job. So whether the significance of personality in the job, how much extent is going to play, so that is more consider important over here. Because if the some of the jobs are more skill oriented. For example, like if I say typist, it's a skill oriented job. Okay, but leadership is a personality oriented job over here. So it means, so here the leadership, it means what type of it means personality that the leadership is having, because he is going to be act as a visionary. Okay, so therefore it means the role, the significance of personality in the job roles need to be assessed first. Then we can say that whether the psychometric test is required for a given particular job or not. And another one is skill testing. Yes, skill, the advantage is it's a direct measure of job specific capabilities that according to the job, because nowadays it means even today it is more prevalent, that is to check this, for example, like typist, the speed of the type. Okay, so how many words that you can that means type in a given minute. So it's just completely a skill test. Okay, over there it means, whereas where it is time consuming and may not be assessed all competencies, it is only a one skill set, but from it is not a comprehensive approach to assess the participant. And another, assessment centers are a holistic view of the candidate abilities, but it is more expensive and resource intensive. That is why the companies sometimes may or may not prefer background checks. It ensures the candidate's credibility. It means what are the credentials or the details has been given by the candidate, so whether those are appropriate, right or not. So that is one. And the major limitation is a privacy concern may delay the hiring process, because sometimes if the background check goes on months together, okay, then definitely they will hold the application and they will not give the offer letter. That is one. And major challenges in the selection process is yes, it may be a bias. Okay, because interviewer bias can affect the fairness of the objective, and it's a time consuming. Selection methods like assessment and interviews can be lengthy sometimes, because we are going with the assessment centers, and if you added the background checkup and you are expecting that after 6 months also there is a background checkup was not completed, okay, that means simply it's a delay. High cost. Okay, so extensive selection process may incur high cost, test tools and external services. So if you are going with the it means any taking the help of hiring companies, for example, like if you go with the psychometric tests, so if you adopt any psychometric test that will be that which has been developed by some third party or maybe some other psychiatrist, then definitely they will charge for it. Okay, it is not a free, because we have not, the companies may not have the all the psychometric tests with among themselves. So the copyright or the rights will be with the creator. So we have to pay for all those services. Legal risk, improper selection method, yes, definitely may lead to these things, and mismatch even with the rigorous selection process. A poor cultural or job fit may still occur. So sometimes, though we follow the some procedures, yes, definitely we cannot say that all the employees who have been selected are the most appropriate and the right fit. Just we can say that from the available pool of candidates, these are the best choice, the choice which we are making, but not exactly the right person with that we have selected for the according to, when we compare with the job, that might be possible. And the best practices. So how can we overcome these challenges? Simply clear the job descriptions over there, that ensuring that the whatever the job that you are going to exhibit, okay, that you are looking for, then clearly give the all the job roles and responsibilities, so that the it means the applicant, while before submitting the application result, can understand that the what are the expectations of the company from the candidates clearly. And then a structured interviews rather than unstructured interviews are preferred. Okay, and the user validated tests use a scientifically proven assessment methods rather than unscientific methods over there. And diversity and inclusion, prioritize diversity in hiring, and to ensure the organizational culture, because more diverse will always bring the more creativity within the organization. So it is a proved relationship, that is why it is also preferred. Coming to the another one, the induction. So induction is the formal process of introducing the new employees to the organization. Okay, because the applicants who are working in maybe new freshers or maybe experienced employees. So in both cases, induction the for any new employee, though it is a fresher or a experienced employee, induction is necessary. Reason one, the first reason, if we simply refer to the assuming that the new recruited or the new selected employee is a fresher, then definitely the fresher may not know the work culture, because he or she just have completed their graduation or post graduation, their academics, and now they are entering into the workforce. So working culture and student culture both are completely different. And point number one. Second point, they should know that what is expected from them. Now they are responsible employees, and they have their own duties that they need to discharge, and they have to build a formal relationship with the peer group, with the supervisors, okay, as well as their subordinates also in case. So it means they have to learn different things, because it is not the similar culture as the academics in the industry. So there are many things that will be in different way, that they need to understand and need to gel with that current organization's culture. That is one point. Whereas to the already experienced employee, that there may be a possibility that yes, the previous organization culture and current organization culture have differences. Okay, here one of the it means I would like to quote one author, that is Herman Goya, who is a consulting running a consulting in the United States of America, who worked a lot on the organizational culture, and finally they stated that organizational culture is like a human DNA. As a DNA differs, similarly the every culture of the organization differs, and there is no right and wrong culture, just the culture is different. So if something is lacking within the culture, something is mismatching, not aligned, you're not getting the required performance, or you're not able to achieve the objectives with the present culture, it indicates that you need to change or you need to revise the culture. It does not mean that there's a wrong culture or a bad culture. You need to change or you need to adapt the culture, that's it. So that is why, so even in the case of the experienced employees also, the culture may differ from one company to another company. So definitely already the employee who is already experienced have already adopted a certain culture, some work ethics, some working environment, and that may or may not be well suited in the current organization or in new organization. So now the employee has to it means change the according to the present organization conditions. Okay, so therefore it means definitely that will take some time over there. So that is why, what is the present organization culture, what are these people are, what are the now new organization is expecting, okay, and how these how we have to show exhibit the behavior, all these things need to be known. Okay, so for that definitely the induction program is necessary. Okay, so that that is why the main purpose of the induction is to settle and quickly feel welcomed, so that the new employees can gel immediately or quickly gel with the current scenario of the organizations. That is why. And there are a few key components are there for the induction. That is yes, that is welcome to the organization, where we are, it means the manager, maybe the superior or manager who is responsible, they will simply introduce the company's mission, vision and their values, what is important and how they perceive in the things from their perspective. So those things, those core values that they will discuss. And then introduction to the team, so that they meet your peer group, who is your leader, who is your superior, who is your subordinate, who is your team member or a department member will be introduced. And then what are the work policies of the organization, okay, what are the rules and regulations, okay, that we need to follow, and the organization structure, that it means the entire hierarchy need to be explained so that they can understand the hierarchical levels of the present organization. Okay, so importance. So finally, it means if it really try to get all this and try to reduce the employees' anxiety. Why? Because we can say that yes, whenever we go to any new place, usually it is completely new environment, so definitely we feel anxiety. That is a common behavior or a common I would say the common behavior over there. So in order to reduce that anxiety, that how the people will react to me, whether how they will receive me, how they will interact with me. So they, because we do not know, we are, because the new employees meeting the company and the team members, leaders, probably for the first time. Okay, so so therefore it means there is a chance of that there is a anxiety, especially such kind of things will be very common in case of new employee is a fresher, because the fresher do not know the working conditions. So definitely they will be more anxiety that how they will be perceived and how they will be assessed, and how they have to exhibit the behavior. Okay, all these things they have to observe the conditions, learn the from the scenarios from the environment, and then they have to exhibit. So that is why anxiety will be there. So, in order to reduce that anxiety, yes, induction will probably helpful to reduce the anxiety by giving the introduction, or by giving the providing some information to know that or to know about the organization, peer group, okay, and the hierarchy. Yes, we will get familiar of all those things. We feel belonging to the organization. Similarly, accelerates the integration process. So when we know that what is the hierarchy, and who is your superior and who is your peer group, then it will simply improve the it means integration among the team members, among the department, and all those things. So improves the employee retention by fostering early engagement and commitment. So when you simply better inform about the organization, all these things, then definitely we feel that yes, we get awareness. We are simply trying to create the awareness about the organization and all these things. Yes, there is a possibility that we will gel quickly with the team, so that we feel belonging to the organization, we feel comfort at the organization. So that will reduce the it means the attrition over there. Okay, and promotes the better understanding. So because when you are giving the once again awareness about the what is your role, what are the expectations of your role, and how you will be measured, or you will be evaluated, who are your superiors. So definitely by giving some basic understanding will definitely helpful while working. Okay, so that will promote in understanding and all those things. So another concept of is the orientation. Okay, so orientation is the first step in the new job. It means we are giving orientation over there. So is a process of familiarizing the new employees with specific job roles similar to induction. Okay, and the working environment. So objective is to equip the employees with the necessary knowledge and skills to perform their jobs effectively from the start. So what are the important aspects? Okay, so in the orientation we can give the job specific training. So that is why most of the freshers will preferably given the training. It means before sending them or before assigning any work, we usually companies will simply send them to a training, okay, to the freshers, okay, so that they can understand the duties and so that they can perform better. Health and safety training at workplace emergency produces and companies health protocols, what are there, all those things need to be given, information will be provided. Office tour, completely familiarizing the workplace, the where the different departments are located, okay, and the entire structure of the organization are there. And setting the expectations, clarifying the goals, it means what is expected from the employee. Okay, so also need to be once again to be instructed clearly. So what is the importance of this orientation? It ensures the smooth job transition, okay, over there, and similarly reduces the initial confusion that employee will not feel that what should I do once I enter into the organization. So that the familiar and the information will be provided to the employee once they enter in as a into the organization. So they will be clear that what are the expectations from the employee and what they have to perform, and similarly helps the employees to understand the organizational workflow, their performance standards and their culture, values and so on. So by providing the information, the all these things will be introduced, and which will strengthen the employee satisfaction and confidence. Definitely when the confusion decreases, the confidence usually it will increase. So that is why we feel satisfied as well as the confidence that might be possible. So another concept is the performance appraisal. Okay, performance appraisal is reviewing of the performance or employees' work. Okay, by through a systematic evaluation. Okay, typically conducted annually or semi-annually over there. So it is mainly focuses on assessing the past performance to determine the strengths and weaknesses and areas of improvement. So similarly, as we could say that we try to identify the what is expected performance and what is current performance. Do we have any gap between these two? Okay, if any gap is existing or a significant gap is existing, okay, then definitely that need to be fulfilled, or that is the area, potential area for the improvement over there. So that is why we have to simply assess the performance of the employees over there. Main purpose is to evaluate the effectiveness and the contribution to the organizational goals. So it means the number of tasks that has been provided or that has been assigned to the employee, out of them how many has been completed. Okay, so that we can measure the contribution from the employee over there. And similarly, we can provide the feedback for the career development. So it means if the employee is working good or a bad, in both cases feedback is more valued, that because the feedback, if the employee is not working properly, not working up to the mark, then you can give a feedback for a scope for improvement. And if the employee is working appropriately, then you can go with the more give a career guidance or career development guidance, that okay, as you are performing better, you can also think of the to achieve, it means increase your standards and benchmark, or you can also think of the some other better opportunities or other levels within the employment. Yes, so it means in both ways the performance appraisal is assessing the performance appraisal is necessary, and it is also helpful for the determining the compensation, promotions and training needs. So because if somebody is a good performer, definitely the compensation will be high and promotions will be given, and maybe for succession planning you are sending a training also, because top performers maybe you are for top performance maybe you are sending to the advanced level of training, or else the poor performers you are sending them to improve their standards, to learn something up to the mark over there. In both ways that is required. Methods, there are traditional and modern methods over there, basically which can be classified, but I have mixed over here it is. So the graphic rating scale, okay, and 360-degree feedback, management by objectives, critical incident methods, okay, are the few over there. So rating scale, it means here we can say that employees are rated on a specific criteria, maybe a concept of punctuality, maybe on a concept of the it means contribution, maybe in the concept of the productivity, maybe in the concept of the teamwork, maybe in the concept of the leadership qualities, maybe in the concept of the like a superior support or a support system, okay, or maybe in the concept of the sharing or sharing the knowledge, in terms of sharing the knowledge how you are, though you can take the any concept. So simply on that we are rating on a maybe 1.5 scale or a 1.7 or a 1.10, it's up to us. So the on that scale we can rate, and that will be referred as the graphic ratings, that we can refer as graphic rating scale over there. So common scales that we can refer as 1 to 5 or 1 to 10. but preferably we can go with 1 to 5 is most easy to interpret when compared to the 1 to 10. So, but there is no rule of thumb among the selection. But if you come up with the less options, then interpretation, classification of interpretation will be very, it means understandable. Okay. Otherwise, it will create the bit confusion over there. Why? Because, for example, like if I go with that one sort of classification, if I go with that, in the case of sharing the knowledge at the workplace, I want to assess on a graphic rating scale. So he mostly to never share. Mostly if I refer 5, or always if I refer 5, mostly yes 4, sometimes 3, rarely 2, never as 1. So never, rare, sometimes, mostly, always. So these are the 5 different levels that we have created. We can refer as a 5-point scale. But it is easy that okay, always to it means we can compare the difference between what always to mostly. Mostly means okay, but not it is always. Always means always 100%. Mostly means it is nearest to, probably nearest to 100%, but yes, but not 100%. Sometimes and meaning of sometime and meaning of mostly, yes, it is not. We can say that sometimes maybe 50-50. Okay, it means rarely in the sense almost never. It means from the this end to the, it means maybe it is in between the 50%, less than 50% itself, less than sometimes itself. And never is always a 0. So from 0 to 100, it means we can classify easily. But if we add one more addition or one more level, that if you could say that it means in the case of the always, mostly, rarely, then we can say that we rarely, mostly, sometimes, rarely. Okay, and then never. So then if we add one more level in between these things, then it will become a difficult to differentiate between the levels. Okay, so that is why the most preferable is 5-point rating scale. Reason for this is that the classifications or the levels what we are going to create or what we are going to use for interpretation, that will be easily understandable, where we can differentiate between the levels easily. If you increase the levels, it will create the difficulties while interpreting the levels or differentiating the levels. That is why. Another performance method is 360-degree. It means, as we can say that from the it means from all dimensions. So feedback collected from the peers, subordinates, superiors, and a well-rounded evaluation. It means more all possible ways. All it means from all dimensions. It means the feedback will be get from your superior, your peers, your subordinates. Okay, maybe from other whoever you are approaching or you are in contact with while working. So all those people will become the potential it means respondents for the feedback to assess your performance over there. So that is why. And another one is management by objectives, which is more popular. That is, we say that employees and managers set mutually agreed upon objectives. It means what are the objectives are has been set. Okay, and how many objectives that are met. Okay, so it means that will be considered as a, it means meeting the each and every objective is will be considered as a achieving the performance over there. Okay, based on achieving of these goals itself. And another one is critical incident techniques. Here the employees will be given with the some phenomena, some scenario, some critical scenario, so that how the employee is behaving, thinking, and exhibiting the discharging the duties, responsibilities over there. So this will focus on some key instances of the job. Okay, over there. So both which can be referred as both positive or negative, and based on which the we simply note the reaction of the employees. So based on that, whether the employees response, the performance will be assessed over there. So this is another method. And potential appraisal. Potential appraisal is another concept which comes in the performance appraisal itself, but it is a process of evaluating the employee's potential for future roles and career growth within the organization. So who can be given the promotion? Okay, so focusing on their capabilities. So who can be given the it means there may be a few people, but you may have the one or two roles to promote, but you may have the more than two people who are actually you feel that eligible are potential candidates for the appraisal over there. So that is why it is a process of the evaluating the employee's potential for future roles and career growth within the organization. So within the organization, who is having the potential to achieve the long term or achieve the achieve that the highest positions or can be given with the highest positions are good in their performance levels. So in that way, it can be assessed. What's the purpose? Purpose is identifying the high potential employees for leadership roles or career advancement, maybe for succession planning. So you are looking for succession planning, but to whom you want to give? Who are the potential candidates? So you want to promote, okay, the employees, but who are the potential candidates? So we have to assess and align the employees' aspirations with the organizational needs. So this alignment is necessary and guiding the succession planning and talent management. So for all these purposes, yes, we need the potential appraisals. Similarly, key aspects. So we have to ensure that their aptitude, growth mindset, leadership, and long-term contribution need to be it means evaluated or need to be focused properly, because ability to learn and adapt is necessary, whereas the leadership role, because it means leadership role in organizations are very key, because leaders are visionaries and the people will definitely follow them. So uh, the work performance and inspirations of the at the workplace also relies upon the leadership. So that is why whether the person is having the capability to lead a team or not. Okay, and growth mindset. So whether the employee is having a growth mindset and to improve him or herself, and also focusing on the improvement of the others, because it means if the employees grow, then definitely or it will also helpful to the organization to grow. So whether the employee is having a growth mindset or not, and long term contributions. So another important thing is, see, long term contributions are it means how these changes or whatever the it means potential appraisals are there, then how these are going to impact in the future, that is also need to be assessed. So what are the methods for potential appraisal methods that we have? The number one is we have the talent pool assessment. So identifying who are having really performing better, or we could say that who are the top performers of the organization in that way. Similarly, we can say that the another method is a succession planning. So evaluating the who is having the capabilities to handle the future roles of the organizations. Okay, so that is why psychological assessments. Okay, so to assess the mental abilities or cognitive or personality traits. Okay, so to assess these things is who is most having a strong emotions, who is psychologically or mentally fit. Okay, who is having the more leadership, what type of different leadership traits that the employees possess, because different employees possess different leadership skills, but what type of traits are the skill it means leadership it means capabilities the employees are possessed. So then, and developmental feedback, regularly coaching and mentoring is also one method, so that we can it means assess the future potential of the employees, so that they can get ready for the new roles in the future over there. Okay, so I would like to stop here. Coaching will start in the next class. Okay, fine. At the time, yeah, 3:58. So just I'm trying to give a brief, I think, hoping that all of you are already working, so that trying to just revise the things and briefing quickly over here. Okay, fine. I will leave. Thank you.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Thank you, sir.
Yeah. Thank you. Will leave.